Well, those are images from what has been a historic Monday. The Lord is finally home in Ayodhya. Lord Sri Ram is home. And what an event it was. I mean, a sight to behold. Prime Minister Modi, other top dignitaries, everyone there celebrating. Of course, I mean, it's not just what happened in Ayodhya. It's, of course, what's happened all across the country, in our societies, in our homes, in our neighborhoods. Just absolute joy and celebration all across. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 News studios. I'm Prashant, with me my colleague Sonia and Nigel. Guys, hi, morning.
Hi, good morning, Prashant. Good morning, Nigel. And, once in a lifetime spectacle, is what we saw yesterday, right? But it also talks about the kind of opportunity that India has in terms of tourism. I mean, we were looking at the numbers. $10 billion is the kind of makeover that Ayodhya has got. And Jeffries, I think, put out a report where they said that Ayodhya will receive about 50 million visitors a year, much more than what you see even at the Vatican or even, in Saudi Arabia. So in that context, infra-driven tourism is something that could see a big boom, and that's the big theme as well for the market.
Well, I think, though we watched it on television, but we were lucky, and many hundreds of years down the line, people will be talking about this day. Yeah. So privileged to at least watch it on the television. Would have loved to be there. Anuj got that privilege. So really big moment for all of us. Glued to the TV all through the day yesterday. Lovely moment, and glad to be part of it.
Absolutely. And, this guys, just one more thing, right? We usually start with, it's a 3-day week. just FYI.
I was going to say, when Nigel said big moment, I said the big moment for us is it's a 3-day week, guys. And then again, we're off to a long weekend, right? I mean, just look at the enthusiasm.
Let's get straight to it.
All right, no, absolutely. Let's quickly tell you what you need to know as we begin another trading session, right? I mean, Saturday was working, so that's the last session. Let me quickly tell you, just one line before we go into the global stuff, etc. So I would say the pullback hopes, when I say pullback, I mean the midweek sell-off that we happened and the pullback that we saw last Friday, and then on Saturday it kind of fizzled out. I would say the hopes are still alive that we will actually recover and continue to pull back, even though on Saturday the close was negative. I mean, the Nifty ended about 0.25% lower. It's a slow start to the global week as well. It's a macro catalyst heavy week. There are 8 central bank decisions this week. By the way, 4 of them are G10. So Japan, you'll hear from the Bank of Japan, etc. So, I mean, it's a decision heavy week in terms of central banks. Equities were mildly higher. Friday's Wall Street we reacted to on Saturday, even though participation, etc. was low. And Friday, Wall Street ended significantly higher. Last night, it was largely flat. I mean, the S&P was up about 0.25%, the Nasdaq about 1/3%. So mildly up. But the point is we're at new highs on indices like the S&P and I think on the Dow now as well. So even a little bit higher is going to be a new high. The 10-year is absolutely flat. The 10-year is down about 2 basis points last night, just still about 4%, 4.1. The dollar index, not very much by way of movement, 103.3 is where it left off. Oil prices, 1.6% up. We're almost up to about $80 a barrel. So oil's been creeping up slowly but steadily, but given the fact that there's been so many geopolitical events and, opportunities for oil to spike all the way, it's not happened. I mean, it's still very sluggish and we're still largely between $75 and $80 now at the upper end of that particular range. The earnings season also gets into full swing. So 16% of the S&P 500 market cap will report earnings this week. And we'll talk more about this a little later. In Europe as well, earnings season for the 4th quarter there is in a full swing. Now, later today, we'll hear from the Republican, who's the Republican nominee for the presidential election, U.S. presidential elections, which is later this year. Most likely, I mean, in all likelihood, Donald Trump, the ex-president, is seen winning New Hampshire. He won the Iowa caucuses last week, and I think he's comfortably ahead if you look at CNN polls, etc. So an eye on this one, which is developing as well. So by the end of the year, when we hit U.S. elections, is once again going to be Biden versus Trump. And, for a sitting U.S. president at this stage, it's many months away, his approval ratings are very, very low. I mean, relatively extremely weak. So Trump is right now on top. Now, just to come back to where we kind of left off and where we go from here, on Saturday, the Nifty reached 21,705 intraday. That's the 50% retracement of the 2-day 600-point fall. But we didn't close there. We closed at 21,570. So far cry from those levels. So that's the first resistance which the Nifty will look to cross. It needs to close above it. The next upside level is 61.8% retracement, which is about 100 points out, 21,800, 21,804 to be precise. And on the way down, I mean, the Nifty's got to defend the low, which is 21,285. It should not break it. I mean, you stay above it and hope stays alive. The Nifty Bank bounce has been weak, even though on Saturday, I mean, it was stronger. It was compared to the Nifty Bank was stronger. We ended about 0.75% higher. And this morning as we start, I mean, there's help from ICICI Bank. The ADR, for example, last night was up about 2.5%. On the way up, the Bank Nifty needs to cross the 38% retracement, which is 46,530. It's not very far away from where we left off. The next level is the 50% retracement, which is 46,868. And on the way down, I mean, the recent low is 45,430, which should not break. And the index needs to stay above it. The GIFT Nifty will come up on your screen. I think we are indicating a 170-point higher start. So at 21,776, I mean, it's going to be above the 50% retracement and very, very close to the 61.8% retracement if we get that start and if we are able to hold on to the gains throughout the course of the trading session. Sonia.
Absolutely. And, the sentiment is positive even after the event yesterday.
Yeah.
As we head into the elections, I think one thing is for sure now there's a higher probability of the BJP coming back in its third term. And that will, of course, be historic, right? The kind of movement that we've seen in the last many weeks and months, both in terms of the economic developments as well as getting, the vote base sort of a bit stronger with a lot of these historic events as well. So that is kind of improving sentiment in the market too. But for our own markets, there are a lot of positive triggers that we're going to focus on today. One, of course, is very strong earnings coming in from ICICI Bank, and that will be the stock in focus. Retail loan growth of 21.4% is what ICICI Bank reported, and the street is definitely going to like that. Axis Bank reports its numbers today, and after a solid showing from ICICI Bank, all eyes will be on Axis as well. Not just that, across the board, Cipla reported very good numbers, revenue growth of 14%. There was a margin improvement as well. Colgate in the FMCG space, revenue growth of 8%. EBITDA was up 30%. Mid-cap tech will be in focus after good earnings from Persistent Systems, decent earnings from Coforge. So across the board in the last 48 hours, we've had some decent earnings from all sectors. Apart from that, of course, the US markets did very well. The Dow Jones hit a record high. It stopped at 38,000 mark for the first time ever, and the S&P 500 is also at an all-time high. So everything is coming together today for the market to do well. There are a lot of big earnings this week. We start off with Axis Bank today. It's a truncated week, but packed in with earnings. So tomorrow there's Bajaj Auto, TVS Motor, Tata Steel, Tech Mahindra. So we have our hands full, and looks like for now sentiment across the nation is also positive given what we've seen yesterday. And apart from that, we have some positive fundamental triggers as well.
Well, that's right, Sonia. It's good to see that the US markets ended higher, so no uncertainty out there. But there is still some uncertainty on how much they'll cut rates by and by when. For example, the Fed tracker was suggesting an 80% probability that they'll cut rates at the start of last week. Currently, it's at around 40%, so those rate cut expectations as well have been tapered down in March. So that's one point that I'll be looking at in terms of Fed commentary and economic data. Coming back home, three big points I'm tracking. One is the ICICI Bank stock. Well, as we mentioned that the ADR ended higher. Is it enough to fire up the Nifty Bank? That's going to be the crucial factor, and that's going to be the driving point for today. Remember, we have the monthly expiry that plays out in this month itself. That's on Thursday. And the Nifty needs to go ahead and conquer the 20 DMA. On Saturday, intraday we went above that. We couldn't decisively conquer that. And the third point is today is the Nifty Financial Services weekly expiry. So that index will do a bit of a jig in the last hour of trade. What do the FIs do? Well, the FIs have added close to 6,000 short contracts. Now it takes the short positioning to around 54%. And if you pull up a chart, just in 1 week, from being net long 80,000 contracts, now they're net short 22,000 contracts. So in a matter of a week, there's a 1 lakh contract swing by the FI. Just take a look at that. That's up for you on the screen. And as I always say, it's not such a bad thing, because sometimes when you have shorts in the system, it protects you, because if you're not seeing the big FI inflows, then at least shorts in the system, if they get trapped on the wrong side, that could be one of the reasons why the markets bounce from here. What happened on Saturday? Well, there was aggressive call writing that we saw. 21,700, 21,750. So the sense you get is the bears believe they have got this covered. In the near term, at least, they believe this 21,700, 21,750 is the level that they can defend. Let's see how it goes. Actually, it should be around 21,750 to 21,800, because there's a fair bit of writing at the 21,750 call. Which brings us to the levels. On the upside, first you look at the 20-day MA. Intraday, we managed to cross it, but you want to decisively close above that and get past that resistance zone of 21,750 to 21,800. On the downside, the recent low that we saw in the past week, well, that becomes an important mark close to around 21,300. If that breaks, no one's talking about life below that 50 DMA, which is 28,800, 20,900 also. That's the broad levels for you. But the Nifty bank, in all probability, it starts well above that 50 DMA, going by what the ICICI Bank stock is likely to do. HDFC Bank needs to stabilize a little bit. Maybe ICICI Bank can take the pinch hitting for now. So that's going to be important. And after the 50 DMA, all eyes will be whether it can scale past the 20 DMA. So the Nifty bank holds the key. Whether or not it can take the Nifty high in today's trading session. For starters, I think the GIFT Nifty was suggesting maybe a bit of a positive take, a big positive take. So we need to decisively close above the 20 DMA today. And if that's the case, fresh all-time highs on the Nifty are waiting for us.
Okay, fresh all-time highs on the Nifty. Lots of data points suggesting that could be the case. So let's kickstart very quickly on the equities front. We have Chetan Seth of Nomura, who says that foreigners have turned heavy net sellers of Asia ex-Japan, ex-China stocks for the first time in 11 weeks, driven by some hawkish Fed speak, which led to a surge in US bond yields and some easing in the March Fed rate cut expectations. Q4 2023 earnings season in Asia ex-Japan started on a disappointing note, yet again with the CY24 consensus index earnings down 0.7% so far and ongoing growth challenges in China rather, yet it appears reluctant to embark on a large-scale stimulus which has disappointed hopeful equity investors.
Okay, let's get you some money market views as well. Abhishek Goenka of IFA Global says markets have paired expectations of rate cuts by the Fed post hawkish comments from the Fed members and strong US labor market, housing and consumer sentiment data. Consequently, he adds US treasuries have sold off and US dollar has firmed up a bit overall. He says as a result of broad dollar strength and a pullback in domestic equities, the dollar INR pair is back with an 83.83, 83 to 83.4 to a dollar. And is expected to trade between 82.7 to 83.4 over the medium term.
Okay. Well, we've got a lot of stock-specific action to track for you. Get to that in just a bit from now in our special Top 10 segment. For the time being, we run you through the list. ICICI Bank, Cipla, Colgate, Persistent Systems, all of them will be reacting to positive news flow. While on the flip side, you have Zee Entertainment that will be under some pressure, IDFC First Bank, Oberoi Realty, J&K Bank, Spandana Spurti and Zensar Technologies. All of them will be reacting to negative news flow.
All right, but first up on on the radar is what's happening with Zee, right? I mean, in the last 24 hours, we got to know that Sony has called off its $10 billion merger deal with Zee Entertainment. There are, of course, going to be a lot of repercussions. Sony has sought a termination fee of $90 million on alleged breaches by the company. I think a lot of people on the street were expecting this to come through, but now it finally has. So what does this mean for both the company as well as for the stock? Nisha's here with more details on all of that. Nisha, morning.
Good morning, Sonia. Yes, it's a big blow coming in. It's a dead end for the largest media and entertainment merger to create a $10 billion company in this particular space. So Zee as well as Sony have called off the merger process after 2 years of rigorous work to get all the regulatory approvals for this large transaction to take place. Now, an emotional Puneet Goenka, when he got this termination letter from Sony at Ayodhya ceremony, calls it a sign of God and says it's a sign to move on from this transaction and look at other growth opportunities. Now, looking at the technicalities, well, Sony has served the termination letter saying that they does not wish to increase the deadline, extend the deadline that had been sought by Zee Entertainment, and has categorically said that the merger conditions did not meet the deadline as the prime reason. They have also slapped a $90 million termination charges on Zee, and that is likely to be contested by Zee. It has said that, and there could be some legal tangle because of the breakdown of relationship between the two parties which were engaged in the merger process. Now, looking at this, the biggest bone of contention which has been speculated widely is Puneet Goenka's MD and CEO position in the merged entity, especially after the SEBI investigation. Surprisingly enough, Sony has not mentioned this as one of the key reasons, wonder why, but Zee Entertainment has nonetheless given a clarification saying that Puneet Goenka was agreeable to step down and had given an alternate proposal which was not agreeable to Sony. They have also said that they will keep evaluating other inorganic and organic efforts to continue the growth of Zee Entertainment. However, this will be a big blow for the shareholders who are waiting with bated breath for the benefits of this merger to really come in to Zee Entertainment. CLSA view is that it has downgraded the stock to a sell rating. The target price is 198 rupees per share. UBS has also said the implied value for per share after the merger process breakdown is likely to be around 190 rupees per share. So the stock of Zee Entertainment will be in focus today.
Thanks a lot for that, Nisha. Well, in fact, Anuj spoke to the MD and CEO of Zee Enterprises after Sony's termination of the deal. Let's listen in to what he had to say.
मैं तो ये मानता हूँ कि जिस काम पे मैं 2 साल से सच्चाई से और मेहनत से लगा था, अगर वो नहीं होता है तो दुख तो जरूर होता है, बट आज के पावन दिन पे इसको मैं पॉजिटिवली लूंगा। देखते हैं आगे क्या होता है।
आप ये मानते हैं कि आगे कुछ और बेटर ऑप्शन होंगे आपके पास?
और क्यों नहीं होंगे, जरूर होंगे। आज के डेट में हमने इतना बड़ा एसेट क्रिएट किया है, तो इस एसेट के लिए तो हम तो यही काम करते रहेंगे कि हम हमारे शेयर होल्डर्स को, हमारे स्टेक होल्डर्स को, हमारे पार्टनर्स को हमेशा वैल्यू डिलीवर करें और उसी तरीके से काम करें।
Okay, well, that's Puneet Goenka, in Ayodhya, talking to my colleague Anuj there. More options ahead, they will come up. It's a good asset. And of course, I mean, some of the comments and thoughts, initial thoughts, because the news hit right there, when that event was taking place. Karan Torani is with us. He's media analyst and sector vice president, research analyst, media, consumer discretionary and internet at Elara Capital. We also have HP Ranina, senior advocate at the Supreme Court, joining in. Gentlemen, good morning. Great to have both of you here. Thanks very much for your time. Karan, your first thoughts. You're someone who was kind of hoping, and you're writing in various notes, etc., as well, that this should get done. But it's not. It's a binary event, as we were discussing the last time you were on the show. It has gone the other way. Your first thoughts?
I think it's a big negative for both the companies individually, because I think, there is no respite from the threat of digital media today. Also, this RIL Disney talks, which are kind of moving towards the advanced stages right now, as per reports. Even that will kind of increase competitive intensity in the market. So it's a big blow for both the companies in terms of their functioning, their growth rates, in terms of their ambitions to scale in the M&A industry. There could be various reasons in terms of, why this is, being called off. Of course, one of the reasons was that, Mr. Puneet Goenka wanted to become the CEO MD, and he did give an alternate proposal to Sony. It could be anybody's guess in terms of what the proposal could be. It could be, having somebody else as CEO instead of him. It could be a high non-compete fee. And these are all media reports which are talking about this earlier as well. So I think it's a very big blow individually for both the companies. And I think it's going to take a lot of time for Sony to, come, or rather Zee, to come back at those valuation multiples what it was historically. Because we had built a lot of synergies, primarily because of, Sony as a company, being an MNC company, bringing a lot of technological expertise into the company, and also driving the overall efficiency in terms of profitability. So it's going to take a lot of time for, Zee, if at all, to come back to the 300 share price, which was there earlier.
Okay, so big blow coming in for Zee, but what are the legal implications of this? HP Ranina, senior advocate at the Supreme Court, is also with us. Mr. Ranina, good morning. Zee is challenging Sony's assertions of breach, contending that its CEO, Puneet Goenka, was even prepared to step down, right, in the spirit of facilitating this merger. What do you see as the next step now legally?
Well, legally, I don't think it depends on Zee whether they want to go into challenge this termination. I don't think they should be advised to do so, but the issue will be of arbitration on that huge amount of $90 million, which is the fee which Sony intends to charge to Zee TV. And on that point, there will be some arbitration. But my view is that apart from Puneet Goenka's being there or not being there, because I think he agreed to step down, the main issue is that Zee has a problem with his books of account, maybe having a problem there. And there may be issues that Sony has taken very serious note of, namely that there may be some related party transactions which have not been cleared up. So I don't know exactly what is the reason for Sony pulling out, because I don't think the issue of the CEO being there is the real issue. The real issue may be something much more, than what is apparent. And my feeling is that Zee was asked to clean up his books by a particular date, that is 31st of December 2023. And maybe this has not happened, and therefore this termination notice has been issued. So really we have to see exactly what are the issues, and if these are the issues of books not being written up or not being cleared up, or related party transactions not being reversed, then there could be a serious problem, and therefore Zee will have to then do its own thing and put its house in order. But I think that the deal is off, and Sony, the Japanese company, is not going to give in or give any further extension of time. So things are off. The only issue will be of coming to the settlement of the $90 million claim which Sony has put on Zee.
Well, we'll have to see, Mr. Raninath, and how the legalities work out with regard to this particular case. But Karan, coming back to you, the promoter entity in Zee has a very small stake. But if you look at the top 5-6 shareholders, well, they have more than 30% stake. Is there a possibility they can still try to push through a deal with Sony, and sideline Mr. Goenka? Is there a possibility, or you don't see that as a possibility? Because Mr. Goenka is talking about other possibilities that could come about. Your take?
I think that process is kind of doable, but it is not going to be easy for these shareholders to come together and probably negotiate a deal with Sony. And even for Sony, they've issued a termination notice in public domain, and for them to kind of again change the guidance back and come with shareholders and do something of this sort, it's going to be tough. It is quite legally possible. I'm not a legal expert, but it looks to be kind of possible that with an EGM or something of that sort, they can make some changes, but it's highly unlikely that that kind of an event will pan out. Also, you have to, not forget the fact here that a lot of legal proceedings will come against Zee. So one is, this entire Sony, asking for the termination fee. The second thing is the ongoing proceedings, by the, the creditors of SL Group, clearly Axis Finance and the multiple names IDBI Bank, which were there. Those proceedings will also, kind of go on. Third thing, of course, is they had a contract with Disney as well, where they had acquired the TV rights for the ICC tournaments, and I think even that some advance payment has not been honored. So there could be some legal blow from Disney as well. So a lot of legal proceedings right now, and things are going to look very complicated for Zee as a company.
Okay, well, someone who had a chance to speak to Puneet Goenka yesterday was Anuj Singhal. In fact, he's joining us now live from Ayodhya. Anuj has been covering the Grand Ram Temple opening in Ayodhya since yesterday. Anuj, good morning. Of course, first on the market and, of course, what you've been seeing at Ayodhya, clearly it's electric, the kind of atmosphere over there. And then we'll come to your discussion that you had with Puneet Goenka. But first, overall, how has it been?
Sonia, good morning. You know what, as they say, क्या लिखे राम पर हिम्मत नहीं है कुछ, तुलसी और वाल्मीकि ने छोड़ा नहीं है कुछ. It's been such an electric atmosphere. I think I have been part of many events. I think I have even covered elections, but I think this was something bigger. This is something that I have not witnessed at such a grand scale. And yesterday I was lucky enough to be part of that gathering, that select few people who were there for Pran Pratishtha, and I had interaction with the top industrialists, the top businessmen, and almost everyone was feeling emotional about the whole event. And right now, the temple has been opened, of course, for the general public. The Chief Minister is here. He's just, actually, he's just walked towards the temple after taking bath at the Saryu temple. So, I will just tell you one thing, that you have to be here to feel the vibes of Ayodhya right now. It feels like, something which is much bigger than what Diwali was. Just phenomenal. And words would be, it would be tough for me to describe. One more thing, it's very cold here right now. It's almost 5 degrees. And that's why, there's a lot of fog as well. But still, that's not deterred people from just lining up for the temple. And I think you're going to see over the next 1 year or so, the administration is expecting that this is going to be the most visited temple city in the country, in the world perhaps, but definitely in the country for sure.
All right, Anuj, we leave it there. Thank you so much for joining us live, and It's great to get that update from you. Thanks very much for joining us here on CNBC TV18. Karan, thank you very much for being here. Mr. Ranina, appreciate your time this morning as well here on CNBC TV18. And we'll sort of lean on both of you as this Zee-Sony story develops, because, I mean, this deal has fallen through, but I don't think this is the end of, the last of what we will hear from both sides with, legal implications, etc., as we discussed. We'll take a quick commercial break here, the first on the program. We'll come back. Our research team will be joining in. Lots of stocks to get to. ICICI Bank reported numbers and so many others. Stay with us.
All right, so the GIFT Nifty is indicating that we'll have a very good start today. We already covered Zee Entertainment and how that will be on our radar, but our entire team is standing by to give you the list of top 10 stocks that you should be focusing on today. Let's kick it off with ICICI Bank. Good set of numbers coming through. Abhishek has the fine print for us. Abhishek, over to you.
Well, it's a good set of numbers coming in. Slightly mixed bag if you take a look at the core operating profit growth, etc. So to begin with, the good part is that the asset quality, one of the best that you are seeing in last 9 to 10 years, with gross NPA ratio and net NPA ratio at 2.3% and 0.44% respectively. Deposit growth of 18.7% YOY is the second highest in last 11 quarters. However, sequential growth of 2.9% is the lowest in last 6 quarters, so they need to pick up on deposits. Overseas book remain strong with respect to net interest margin being at 1.47%. The subsidiaries quarterly PAT is at all-time high of 1,994 crore, led by the fact that all-time high quarterly PAT is seen for ICICI Pru, ICICI Tech as well as ICICI Home. What is the weak part? The core operating profit growth, that's at just 10.3% YOY, perhaps the lowest growth that you are seeing in last 17 quarters. Net interest margin is at 5-quarter low of 4.52% versus 4.61%, in line with management guidance that net interest margin will be declining, and they expect further decline in net interest margin in Q4. RWA to advances, that is risk-weighted asset to advances, is at 14-quarter high. With respect to the PNL, NI and PAT is a beat on our poll. Back to you.
Okay, all right, Abhishek, thanks a lot for that. So ICICI Bank look good, but IDFC First Bank not so good, Abhishek?
Well, not so good in the fact that, net interest margin has not translated into ROA. So net interest margin is at all-time high of 6.42% versus 6.36% YOY and about 6.32% sequentially. In terms of RWA to advances, it's at 9-quarter high and perhaps industry high of 117.8%. A 6-quarter high and one of the worst in the industry with respect to cost to income ratio being at 73.1%. ROA, that is return on asset, is at 6-quarter low of 1.06% versus 1.11% YOY and about 1.16% sequentially. The good part is that the CASA ratio has improved, versus the industry trend of a declining CASA ratio. IDFC First Bank has seen some, improvement in the CASA ratio sequentially. Slippages are elevated at 1,422 crore, and for last, 3 years or so, their quarterly slippage ratio has been north of 2.5%, which is a worry factor. In terms of PNL, NI is a beat on our poll. However, PAT is below our poll. Back to you.
All right, Abhishek, thank you very much for that. Lots of financials, banks in focus, but Cipla is the other one. So all-round decent performance from Cipla. Ekta is here with details. Ekta, morning.
Thanks for that. Well, firstly, Cipla wasn't supposed to come out with numbers yesterday. They preponed their board meet because there was a possible leakage of their numbers which took place. But nonetheless, revenue up 13.7%. The street was anticipating 11% growth. Margins better than expectations. In fact, has probably come in at the highest levels ever at 26.5% versus estimates of around 23 to 24%. And the profit was higher than estimates as well, despite an impairment of around 195 odd crores. Now, the US drove sales. So US was around $230 million versus $218 to $225 million in terms of estimates. India was up in double digits for the third consecutive quarter. So India was up 11.6% year on year. International markets and API markets were flat on a Q-on-Q basis, but the margins did make up for it, and the fact that the US grew for the 15th consecutive quarter. Now, there is a call which is going to take place on the 25th of Jan at 4:30 p.m. More details from the management then, but for today, despite despite the stock run-up that we've seen, over 50% from its 52-week low, the margins and the US sales could probably drive the stock a little higher.
All right, thanks a lot for that. Let's hop across to Mangalam now. He's going to tell us how Colgate's numbers look this time around. Mangalam, over to you.
Well, it's a good set that came in. In fact, the management told us before the quarter that, the momentum that they'd gained in the first half will continue in the second half, and that did continue. Revenues were up 8%, EBITDA was up 30%, and the net profit was up 36% year-on-year. And these numbers not only were good standalone, but even if you compare it to our poll on both the top line as well as the bottom line, it was a big beat. And the biggest beat was also led in the margins, that the company reported margins of 33.6%. What was that led by? Gross margins up 630 basis points, near 72.5%. The company did not scale back on ad spends. In fact, they added more. So ad spends as a percentage of sales were also up by 150 basis points. But despite that, the EBITDA margins were up nearly 550 basis points. The company said the toothpaste segment achieved double-digit growth. The business saw positive volume expansion. The only quibble on the street is that the volumes for Colgate this time around have been low single-digit. But then again, volumes have been low single-digit for the entire FMCG sector. So it will be important to see where Colgate performs from here. My sense is it should open in the green.
All right, Mangalam, thanks very much for that. Well, let's talk about Persistent Systems. I think out of the IT pack, one of those few which has done so well over the last 1.5 to 2 years, which has generally been tough for the space. Rima is here with details on this one. Rima, hi, morning.
Hi, good morning. So Persistent has reported another strong quarter in what would have been a very challenging, last 3 months for the industry. So constant currency revenue growth at 3.1% ahead of estimates. The company's margins too have expanded and come in at 14.5%. The board has approved a stock split in the ratio of 1:2. In terms of total deal wins, they are higher on a quarter-on-quarter basis by nearly 9%. And most of the companies have reported lower deal wins, citing a weak macro and seasonally tough quarter. But for Persistent, the TCV has gone up, though the new TCV has declined on a sequential basis.
All right, thanks a lot for that. Well, Oberoi Realty is the other stock that we're looking at. Let's find out how it did this time around. Sonal is here with the fine print. Sonal, over to you.
Good morning, Sonia. Well, Oberoi Realty's pre-operational update the operational update was lower than what the street was working with. The pre-sales volumes was up 18% on a quarter-on-quarter and on a YOY basis, but there was a decline in pre-sales on a quarter-on-quarter basis by 18%. There was an increase of 25% on a YOY basis. But despite all this, the numbers are below than what the street was estimating. The company says, however, in the month of January, they did pre-sales of around 822 crore rupees from their new project in Goregaon. Ambit says the average selling price declined quarter-on-quarter amid higher share of low-value launches, especially the one from Thane, and the sales are below estimates as well. Morgan Stanley has an underweight rating. They say third quarter pre-sales, margins, values, all of them were below the street expectations, and pre-sales could result in underperformance versus the peers which have done good operational performance in quarter 3, but pre-sales have picked up in fourth quarter, so the outlook is positive, but third quarter numbers lower than the peers and lower than estimates as well.
All right, Sonal, thanks very much for that. Let's go back to Rima. Zensar Tech also reported. She's got details. Rima.
Well, Zensar has reported a weak quarter. The company's revenues have fallen by 3.8% quarter-on-quarter. The company said in the call the furloughs in Q3 were deeper and wider than what they saw last year. Margins too have fallen by 140 basis points sequentially, driving a 7% decline in the profitability. So Zensar stock has seen a fabulous run-up in the last 1 year, but these numbers are a bit muted.
Okay, all right. Thanks a lot for that, Rima. Well, let's go back to Abhishek. Abhishek, you want to tell us about J&K Bank as well as Spandana Spurti?
Well, asset quality woes are, coming into the BFSI sector. Slippages have increased 23.5% quarter-on-quarter for J&K Bank. Annualized slippage ratio of 1.24% versus 1.03% in the previous quarter. Loan growth remained muted at 15.5% YOY and about 2.2% sequentially. The net interest margins saw a sharp decline to about 3.83%, decline of about 24 basis points on a quarter-on-quarter basis. So NII growth was weak. It grew by just 1.8% YOY and it was down 4% sequentially. Lower provisions helped their earnings grow by 35.1% YOY and about 10.5% sequentially. For Spandana Spurti, the net interest margin dipped sharply on a sequential basis, 13.3% versus 14.1% in the previous quarter and about 13.8% in the same quarter last year. So there is a sharp reduction in the net interest margin. NII is down 3% quarter-on-quarter, leading to operating profit decline of 8% quarter-on-quarter. Asset asset quality deteriorated. Gross NPA in absolute value increased by more than 22% quarter on quarter. As a ratio, it was at 1.61% versus 1.4% in the previous quarter. AUM growth remained robust at 51.8% YOY and more than 6% sequentially. Back to you.
Okay, well, long day ahead for you as well, tracking all of these numbers. Abhishek, thanks for providing all of those details for us. Here's a quick recap of our top stocks with positive news flow: ICICI Bank, Cipla, Colgate, Palmolive, and Persistent Systems. While stocks with negative news flow, Zee Entertainment, of course, a big setback there. IDFC, First Bank, Oberoi Realty, J&K Bank, Spandana Spurti, and Zensar Tech. Take a short break. On the other side, Amnish Agarwal of Prabhudas Ireda will join in to analyze all of these stocks for us. We will also be connecting with Manish Tandon of Zensar Technologies for their Q3 earnings. Stay tuned.
Yeah, Ajay, look at your dad.
All right, so the GIF Nifty is indicating that we'll have a very good start today. We already covered Zee Entertainment and how that will be on our radar, but our entire team is standing by to give you the list of top 10 stocks that you should be focusing on today. Let's kick it off with ICICI Bank. Good set of numbers coming through. Abhishek has the fine print for us. Abhishek, over to you.
Well, it's a good set of numbers coming in. Slightly mixed back if you take a look at the core operating profit growth, etc. So to begin with, the good part is that the asset quality, one of the best that you are seeing in last 9 to 10 years, with gross NPA ratio and net NPA ratio at 2.3% and 0.44% respectively. Deposit growth of 18.7% YOY is the second highest in last 11 quarters. However, sequential growth of 2.9% is the lowest in last 6 quarters, so they need to pick up on deposits. Overseas book remain strong with respect to net interest margin being at 1.47%. The subsidiaries quarterly PAT is at all-time high of 1,994 crore, led by the fact that all-time high quarterly PAT is seen for ICICI Pru, ICICI Tech as well as ICICI Home. What is the weak part? The core operating profit growth, that's at just 10.3% YOY, perhaps the lowest growth that you are seeing in last 17 quarters. Net interest margin is at 5-quarter low of 4.52% versus 4.61%, in line with management guidance that net interest margin will be declining, and they expect further decline in net interest margin in Q4. RWA to advances, that is risk-weighted asset to advances, is at 14-quarter high. With respect to the PNL, NI and PAT is a beat on our poll. Back to you.
Okay, all right, Abhishek, thanks a lot for that. So ICICI Bank look good, but IDFC First Bank not so good, Abhishek?
Well, not so good in the fact that, net interest margin has not translated into ROA. So net interest margin is at all-time high of 6.42% versus 6.36% YOY and about 6.32% sequentially. In terms of RWA to advances, it's at 9-quarter high and perhaps industry high of 117.8%. A 6-quarter high and one of the worst in the industry with respect to cost-to-income ratio being at 73.1%. ROA, that is return on asset, is at 6-quarter low of 1.06% versus 1.11% YOY and about 1.16% sequentially. The good part is that the CASA ratio has improved, versus the industry trend of a declining CASA ratio. IDFC First Bank has seen some, improvement in the CASA ratio sequentially. Slippages are elevated at 1,422 crore, and for last, 3 years or so, their quarterly slippage ratio has been north of 2.5%, which is a worry factor. In terms of PNL, NI is a beat on our poll. However, PAT is below our poll. Back to you.
All right, Abhishek, thank you very much for that. Lots of financials, banks in focus, but Cipla is the other one. So all-round decent performance from Cipla. Ekta is here with details. Ekta, morning.
Thanks for that. Well, firstly, Cipla wasn't supposed to come out with numbers yesterday. They preponed their board meet because there was a possible leakage of their numbers which took place. But nonetheless, revenue up 13.7%. The street was anticipating 11% growth. Margins better than expectations. In fact, has probably come in at the highest levels ever at 26.5% versus estimates of around 23 to 24%. And the profit was higher than estimates as well, despite an impairment of around 195 odd crores. Now, the US drove sales. So US US was around $230 million versus $218 to $225 million in terms of estimates. India was up in double digits for the third consecutive quarter. So India was up 11.6% year on year. International markets and API markets were flat on a Q-on-Q basis, but the margins did make up for it, and the fact that the US grew for the 15th consecutive quarter. Now, there is a call which is going to take place on the 25th of Jan at 4:30 p.m. More details from the management then. But for today, despite the stock run-up that we've seen over 50% from its 52-week low, the margins and the US sales could probably drive the stock a little higher.
All right, thanks a lot for that. Let's hop across to Mangalam now. He's going to tell us how Colgate's numbers look this time around. Mangalam, over to you.
Well, it's a good set that came in. In fact, the management told us before the quarter that, the momentum that they'd gained in the first half will continue in the second half, and that did continue. Revenues were up 8%, EBITDA was up 30%, and the net profit was up 36% year on year. And these numbers not only were good standalone, but even if you compare it to our poll on both the top line as well as the bottom line, it was a big beat. And the biggest beat was also led in the margins, that the company reported margins of 33.6%. What was that led by? Gross margins up 630 basis points, near 72.5%. The company did not scale back on ad spends. In fact, they added more. So ad spends as a percentage of sales were also up by 150 basis points. But despite that, the EBITDA margins were up nearly 550 basis points. The company said the toothpaste segment achieved double-digit growth. The business saw positive volume expansion. The only quibble on the street is that the volumes for Colgate this time around have been low single digit. But then again, volumes have been low single digit for the entire FMCG sector. So it will be important to see where Colgate performs from here. My sense is it should open in the green.
All right, Mangalam, thanks very much for that. Well, let's talk about Persistent Systems. I think out of the IT pack, one of those few which has done so well over the last 1.5 to 2 years, which has generally been tough for the space. Rima is here with details on this one. Rima, hi, morning.
Hi, good morning. So Persistent has reported another strong quarter in what would have been a very challenging, last 3 months for the industry. So constant currency revenue growth at 3.1% ahead of estimates. The company's margins too have expanded and come in at 14.5%. The board has approved a stock split in the ratio of 1:2. In terms of total deal wins, they are higher on a quarter-on-quarter basis by nearly 9%. And most of the, companies have reported lower deal wins, citing, a weak macro and seasonally tough quarter. But for Persistent, the TCV has gone up, though the new TCV has declined on a sequential basis.
All right, thanks a lot for that. Well, Oberoi Realty is the other stock that we're looking at. Let's find out how it did this time around. Sonal is here with the fine print. Sonal, over to you.
Good morning, Sonia. Well, Oberoi Realty's pre-operational update the operational update was lower than what the street was working with. The pre-sales volumes was up 18% on a quarter-on-quarter and on a YOY basis, but there was a decline in pre-sales on a quarter-on-quarter basis by 18%. There was an increase of 25% on a YOY basis. But despite all this, the numbers are below than what the street was estimating. The company says, however, in the month of January, they did pre-sales of around 822 crore rupees from their new project in Goregaon. Ambit says the average selling price declined quarter-on-quarter amid higher share of low-value launches, especially the one from Thane, and the sales are below estimates as well. Morgan Stanley has an underweight rating. They say third quarter pre-sales, margins, values, all of them were below the street expectations, and pre-sales could result in underperformance versus the peers which have done good operational performance in quarter 3, but pre-sales have picked up in fourth quarter, so the outlook is positive, but third quarter numbers lower than the peers and lower than estimates as well.
All right, Sonal, thanks very much for that. Let's go back to Rima. Zensar Tech also reported. She's got details. Rima.
Well, Zensar has reported a weak quarter. The company's revenues have fallen by 3.8% quarter-on-quarter. The company said in the call the furloughs in Q3 were deeper and wider than what they saw last year. Margins too have fallen by 140 basis points sequentially, driving a 7% decline in the profitability. So Zensar stock has seen a fabulous run-up in the last 1 year, but these numbers are a bit muted.
Okay, all right. Thanks a lot for that, Rima. Well, let's go back to Abhishek. Abhishek, you want to tell us about J&K Bank as well as Spandana Spurti?
Well, asset quality woes are, coming into the BFSI sector. Slippages have increased 23.5% quarter-on-quarter for J&K Bank. Annualized slippage ratio of 1.24% versus 1.03% in the previous quarter. Loan growth remained muted at 15.5% YOY and about 2.2% sequentially. The net interest margins saw a sharp decline to about 3.83%, decline of about 24 basis points on a quarter-on-quarter basis. So NII growth was weak. It grew by just 1.8%. 13.8% YOY, and it was down 4% sequentially. Lower provisions helped their earnings, grow by 35.1% YOY and about 10.5% sequentially. For Spandana Spurti, the net interest margin dipped sharply on a sequential basis, 13.3% versus 14.1% in the previous quarter and about 13.8% in the same quarter last year. So there is a sharp reduction in the net interest margin. NII is down 3% quarter-on-quarter, leading to operating profit decline of 8% quarter-on-quarter. Asset quality deteriorated. Gross NPA in absolute value increased by more than 22% quarter-on-quarter. As a ratio, it was at 1.61% versus 1.4% in the previous quarter. AM growth remained robust at 51.8% YOY and more than 6% sequentially. Back to you.
Okay, well, long day ahead for you as well, tracking all of these numbers. Abhishek, thanks for providing all of those details for us. Here's a quick recap of our top stocks with positive news flow: ICICI Bank, Cipla, Colgate, Palmolive, and Persistent Systems. While stocks with negative news flow, Zee Entertainment, of course, had big setback there. IDFC First Bank, Oberoi Realty, J&K Bank, Spandana Spurti, and Zensar Tech. Take a short break. On the other side, Amnish Agarwal of Prabhudas Ireda will join in to analyze all of these stocks for us. We will also be connecting with Manish Tandon of Zensar Technologies for their Q3 earnings. Stay tuned.
Yeah, Ajay, look at your dad.
Hope you're having a good morning. Let's get cracking with some fundamental analysis on all the stocks that we laid out for you. We have Amnish Agarwal, Head of Research at Prabhudas Lilladhar, who joins us on the show. Hi, Amnish. Good morning, and thanks so much for joining in. Amnish, I wanted to review an ICICI Bank. HDFC Bank was a big disappointment for the markets, but ICICI Bank looked quite good. How do you see the stock panning out from here, and your preference between the two?
You see, the main reason why HDFC got hammered was because they are running a credit deposit ratio of 110%. And if you look at the current situation where the merger has actually happened only recently, the quantum of money which they require to come in a comfortable band of 80 to 90% means that either they will have to, say, sacrifice some sort of a margins, or there could be some issue with the growth, at least in the near to medium term. Okay, so that is I would say, the difference between the two. Now, if you look at the numbers, ICICI, I think if you look at the entire banking sphere, it continues to outperform. Their numbers are better than, I would say, most of the other players, and it has been very consistent. And that's the reason today that it is getting rewarded, and you can say the multiples are getting re-rated. Now, I believe that in the current scenario, the visibility in ICICI looks better than most of the other banking stocks, and we believe that ICICI will continue to get re-rated gradually.
Okay, ICICI Bank will continue to get re-rated. Amnish, hi, good morning. A couple of other stocks in focus, right? From the entire earnings season that you've seen so far, what has stood out for you? Which are the stocks where perhaps earnings have been good and valuations are not looking as expensive, where you could perhaps put more money to work?
Okay, see, it's very, I would say, difficult to find such sector, and if you dissect across sectors, for example, at the beginning of this entire earnings seasons, or rather, if you take slightly longer, all hopes this year were on 2-3 segments in particular. If you look, one was your banking, second was IT, and the third was, say, stocks like Reliance. So these three baskets in particular had a weight of, say, more than 55-60% of Nifty, and that was giving the hope that the Nifty will continue to inch higher. But now, as you stand today, say, you can say close to, say, around 10-15 days into the earnings season, there has not been, I would say, particular outliers. Banking has been mixed, as we were discussing. For example, ICICI has been good, Kotak has been okay, and your HDFC has disappointed to some extent. So, in terms of, say, some of the other stock, if you look at, say, IT space also, although it might seem that it might have bottomed out, the visibility in terms of, say, the growth still might be, say, a couple of quarters away. Similarly, if you look at numbers coming from the consumption space, actual was nothing great. Asian Paints was okay, and Colgate again driven more by margin. So I would say that in terms of outliers today, it has become slightly difficult because it is turning out to be very stock specific kind of a scenario. Certain segments, even in a particular sector, they are doing well, and that is why the stocks are doing better over there. But I think it is very mixed kind of a scenario. Very difficult to today, you can say, find a particular segment or stock which clearly would say outshine. Some of the, for example, if you give purely by numbers, current quarter were good for Asian Paints, but the outlook was mixed. ICICI has given numbers which are really good. Similarly, you can say Cipla's numbers were good. So I think you will find stocks, you can say, which have been outliers and are doing good.
Okay. Well, one stock that has been not performing that well is Zensar Technology. So, Amnish, we have the management joining in. Would request you to listen in and then perhaps give us your comment as well. It was a weak set of numbers for them. The revenues were down 3.2% quarter on quarter. It was impacted by seasonal furloughs and the margins also contracted. Manish Tandon, the Managing Director and Chief Executive Officer at Zensar Technologies, joins us now. Manish, hi, good morning and thanks for joining in. You know, your revenues were down at a time when many of your peers have been reporting very strong numbers. Apart from the furloughs, the seasonal furloughs, was there any other factor that contributed to this downfall? And what is the prognosis over the next couple of quarters?
Yeah, so first of all, I would argue that the numbers are pretty good if you look at year-on-year comparisons. See, this is a seasonal quarter. And depending on your concentration, client concentration in certain sectors, your numbers will go up or down or will go more down. But if you look at our year-over-year numbers, we have seen secular growth. South Africa for us is up 18% in constant currency. UK, Europe is up 12%. BFSI is up 12%. MCS, which is manufacturing and consumer services, is up 7.7%. In fact, the only sector that has not done well for us is high tech. And unfortunately, high tech is about 35 to 40% of our exposure. And hence, that is reflecting in the sequential QOQ of 3.3% negative. But as I said, we are very pleased with the results. And as far as investors are concerned, I've always maintained that it's more about the profits. And year over year, our profits have increased 108%. Our PAT has increased 108% compared to last quarter. So we are making very good progress. And I am pretty pleased with the performance that we've had.
Okay, but you know, on the margin front, I understand that your margins at 17% plus are healthy and better than what you've guided for, but it's down quarter on quarter, and this despite no wage hike this quarter. What explains that, and what is the average margins that you're looking to do? Yeah.
That is very simply explained that last quarter, when we did 18.6%, we had explained that it's a 1.6% one-time impact, positive impact on certain things. So our normalized margins last quarter were 17%. This quarter, our normalized EBITDA margins are 17.2%, despite significant furloughs and a lot of headwinds in terms of negative revenue growth. As I said, I'm very pleased with the numbers and our performance as far as EBITDA margin is concerned. And to answer your other questions, we have always maintained that we will maintain EBITDA margins in the mid-teens, and we are well above those numbers.
All right. Manish, hi, morning. I've said it quite a few times that you're quite pleased with the past quarter, but I want to understand the way ahead. Will quarter 4 be a growth quarter, and are furloughs getting extended into quarter 4 as well?
Furloughs always get extended to quarter 4. Last 2 weeks of December and 1 week of January. First week of January is when most furloughs happen. The impact of furloughs is less in January than it is in December. So that is as far as furloughs are concerned. Otherwise, as I said, we are seeing good
growth numbers except for a high-tech portfolio. And if we can manage, if the ground situation improves in high-tech, then we will continue to see growth.
Manish, hi, good morning. Prashant here. Just two questions. One, on the healthcare side, you've reported the third quarter of a drop there. Why and by when does it recover? Some of the peers who've reported numbers so far, they've reported growth. So did you lose a client or something, if you can tell us? And second, yeah.
Go ahead.
And on M&A, should we hear from you something soon? An acquisition or something?
Number one, healthcare, actually, we started healthcare as a vertical just 2 quarters back. This was our first quarter where we carved out healthcare as a vertical. And I think the reason for the decline has been that there were some large projects that got completed. We are building up the healthcare team. As you know, I have extensive experience in healthcare and life sciences. So we are building up that team, and it is a sector which we plan to grow in the coming few quarters.
On M&A, Manish?
Yeah.
On M&A acquisition, something we should expect soon? Anything you can tell us?
We are sitting on about $250 million of cash. Cash position is good. We continue to look at almost every week. We are looking at a company which can fit with our strategy and comes at a price where I can maintain my fiduciary responsibility to the shareholders and not overpay for this thing. So all of us are working hard. There is a specific team working on it. I myself am personally involved, and we continue to look at assets. But we will not do any acquisition just for the heck of it.
Okay. Every week you're looking at a company. This is one company, or you're looking at many companies?
No, as companies come in the market, we evaluate them as per our strategic needs, and we take 1 or 2 companies forward over a period of time. At this stage, we are looking at 3 companies.
3 companies. Okay.
Things are where we are communicating with the bankers. But let's see. You never know how these things pan out.
All right, we'll leave it at that. Thanks a lot for joining in. Your stock has done very well in the last 1 year. If you pull up a 1-year chart, the stock is up 150%, one of the biggest performers. But this quarter, the numbers were impacted because of seasonal furloughs. So let's see how things go from here. Let's take a quick break. On the other side, Mitesh Thakkar and Sudarshan Sukhani will be joining in for some technical trades. Stay tuned.
No one.
Okay, welcome back. 5 minutes to go for the pre-open session. Mitesh and Sudarshan are with us with what they make of the market this morning. Gentlemen, good morning. Great to have both of you here. Mitesh, over the last 2 days, the S&P is up 1.5% or so. On Saturday, we traded, but institutions were absent, both local and foreign. So in that sense, are we going to make up for that today with some more buoyancy? And what's your sense? Will we again fizzle out around the 21,700 or 21,800 kind of levels, or this will go?
Morning, Prashant. The SGX is indicating a gap up of about 190 odd points. I think, 21,750 will immediately come into picture. Now, if we can sustain about that for an hourly closing, I think we should see the momentum carry to about 21,900, 950 zones. Otherwise, I would be in a mood to take some profits off the long positions. On the stock side, I have buy calls on Adani Port. Keep a stop at 1160. Look for targets of 1250. A buy on Coal India with a stop at 392.5 for targets of 410. And a buy on Aarti Industries with a stop at 655 for targets of 700. And one sell call. Polycab, if it breaks below 43.10, go short with a stop at 43.70 for a target of around 4,200.
Okay, all right. Those are all your stocks. Thanks for that. Well, Sudarshan Sukhani is also joining in. Sudarshan, 170-point bump up is what the GIFT Nifty is suggesting. A lot of things working in our favor, but your call on how you would approach the markets and what are the stocks to look at?
Well, the Nifty and the Bank Nifty are both buy on sharp dips.
So that's a place where you take a long position when the opportunity arises. Colgate is a buying opportunity. The stock has run up. Keep a stop under 25.10. Look for higher levels. HDFC Life is an intraday short. Stop above 618. Similarly, Jubilant Foods is in a bear market. Intraday short with a stop above 522. And Hero MotoCorp is a buying opportunity. Similar charts as the other bullish ones. Buy with a stop under 43.40.
All right, thanks a lot for that. We'll do one thing. We'll take a short commercial break. We'll come back with the pre-opening rates. We will also speak about Ireda, which has been one of the fast-moving stocks in the last couple of months. Pradeep Kumar Das of the Indian Renewable Energy Development Agency will focus on their Q3 earnings. Stay tuned.
Co-powered.
Welcome back. There's what, we had actually kicked off the pre-open session and we'll have the rates come up for you in just a bit from now. It's going to be a strong start as the GIFT Nifty has been indicating for the last hour or so. But it's also a full-fledged earnings season. IREDA reported a strong set of third quarter numbers. Loan growth has been robust. There's been margin improvement. Stock, of course, has done phenomenally well. We've got the managing director and chairman of the company, Mr. Pradeep Kumar Das, joining in to run us through the numbers and, of course, what the future looks like. Sir, good morning. Great to have you with us here. Thanks very much for your time. Prashant this side. We're going to get to numbers in just a bit, Mr. Das. I want to just read out this tweet from, what the Prime Minister put out yesterday, because this has got some important business implications as well. If you can have the quote up. This is the Prime Minister yesterday. He said, all the devotees of the world always get energy from the light of Suryavanshi Lord Sri Ram. Today, on the auspicious occasion of the consecration of Ayodhya, my resolution got further strengthened that the people of India should have their own solar rooftop system on the roof of their houses. The first decision I've taken after returning from Ayodhya is that our government will launch Pradhan Mantri Suryodaya Yojana with the target of installing rooftop solar on 1 crore houses. That's 10 million houses. This will not only reduce the electricity bill of the poor and middle class, but will also make India self-reliant in the energy sector. Solar rooftop, on 1 crore houses. That's essentially what the Prime Minister is talking about here. That's a big number, but it's also extremely positive in terms of our march towards having sustainable, renewable energy. Mr. Das, good morning again. I just wanted you to react to this, sir. Talk to us a little bit about, in your opinion, how will this be implemented? Who will be the nodal agency? I mean, with your sort of historical context, and of course, your association with banks, etc. You also do work in the renewable sector, financing the renewable sector. Just talk to us about this.
A very good morning, Prashant, and good morning to viewers. First of all, what our Honorable Prime Minister has announced, though the announcement came just after this auspicious Ramlala in Karsan, but he has been talking about renewabilizing the country and globe focusfully, passionately, spiritually, and holistic development of renewabilization in the country is happening. Now the things are getting visible, but to be very frank, unless every household is using renewable energy and every individual will be having on their handset mobile charge through renewable and in their steering, which is empowered by renewable energy, till such time, it is very difficult to achieve the optimum renewabilization in the country. So Honorable Prime Minister's announcement immediately post this ceremony is a perfect timing to sensitize the en masse Indians and en masse population of the globe, I should say, that how important renewable energy is for our survival and enabling a cleaner environment for our generation to
Mr.
come.
Mr. Das, could you put some numbers to it? What's the size of this opportunity? The solar rooftop, would you have some numbers or it's too early?
No. See, we require around 1 crore of households announcement has been made. And each household in a range of 1.5 kilo to 3 kilowatt of requirement will be there. And this exact number will be working out very soon. But around 7,294 per kilowatt in particular states, the assistance form around 9,000 rupees per kilowatt general states assistance form has been announced. And 3 kilowatt capacity has been raised to 18,000 per kilowatt in phase 2 program by Government of India, also MNRE.
Mr. Das, yes, we got that. Yeah, go ahead.
You are asking about the nodal agency. Already REC, that is the Rural Electrification Corporation, has been named as the nodal agency. And the way the Deen Dayal Upadhyay household electrification was done, in the same sense and spirit, the several power CPSEs has been entrusted the responsibility to handhold REC. And we have signed a fair amount of MOU with the bankers. See, Ireda being the pioneer in this sector and working solely in renewable. Our entire balance sheet is renewable only. And we are having fairest amount of experience and expertise in this field. We will
Mr. Das? Yes, I understood that. I just wanted a couple of more numbers for Ireda particularly, right? The AUM book currently is about 50,000 crores. Can you tell us what is the kind of opportunity, what is the growth that you're looking at in AUMs, both FY24, FY25? Are we looking at 70,000, 80,000, 1 lakh crores? Just trying to understand what could the growth look like for Ireda.
See, a couple of years back, we had announced by 2026, we'll be having 1.96 lakhs crores of year. That is much prior to our IPO. During IPO days, as well as now also, I have been telling that we are not focusing a number because we do not focus on any specific target. Because the opportunity is so huge and the responsibility is so huge, we'll be always fully leveraging our net worth. Now, with post equity and post our December result, our net worth has grown up fair amount, fairly, and we'll be trying to leverage fully at least to the almost about 6 to 7 times of the net worth, so that we maintain the healthy CRAR. So the numbers is going to follow. So even if I tell you X number, you never know, and we'll be resorting to all kind of sources, like after fully leveraging our equity, we can go up to also perpetual debt kind of thing to further leverage our RBI limits, so that we can go to the fullest extent. And as I said, by 2026, since our earlier announcement was 1.96, you never know. And when 3 years back, we had a book size of hardly 24,000 crore. And today we have crossed 50,000 crore. And very soon we'll be surpassing the bigger figures also. Exact numbers we are not putting on the target at all. And if you see the team Ireda's effort always.
Got it. You know, Mr. Das, as you're saying, and you're putting it so beautifully, that there's a tremendous scope of growth. So we'll wait for growth to flow through. But we're running into market opening. So I wanted 2 big quick numbers from you. Your cost of borrowing, I think, is around 7.82% approximately. Give and take everything, what was the sustainable NIMs look like, from year on? Give us a broad range. And the second point is the ROA. What kind of a target do you have out there? Can you do 2.5%?
We'll be always targeting in the range of 2.5%, because we do not go superficial margin in NIM, because we are a developmental organization. And more and more we enable the sector to grow, more and the more business not only we'll get, also the banks and other contemporaries who are working in this field, they will also get. And see, our objective is to support 500 gigawatt achievement at the earliest.
Yes. So 2.5% ROA is definitely gettable. And NIMs, the rough range, are very quickly?
See, we are targeting. I'll not say it is definitely or something like that. So, and see, if you see our last 9 months performance, all parameters we have improved. And even during my IPO interviews, I have already said that we are not targeting number, but we are focusing on our fundamentals. And that once that is there, every parameters will be growing. If you look at except NPA, we have increased everything. But NPA, we have decreased. So that is what our approach is. And you see, we are not a very big organization, hardly 178 manpower. But within that, what business we did 3 years back, we have just more than doubled in 3 years. And we are targeting to even further double within the same manpower. So our focus is on automation, ease of doing business, transparency, and accountability.
All right, we'll leave it at that. All the best. Thank you so much for joining us. And you've, your stock has done very well for investors too. So hope that trajectory continues. That's Ireda up about 5%. Looks like the market is going to have a very solid up move this morning. Cipla is topping the charts after a good set of numbers, 5.5% higher. And of course, ICICI Bank. So we have it good this morning. Sudarshan is back with us. Sudarshan, what's the big call at 9:10?
Well, Colgate is a buying opportunity with a stop under 25.10.
Ish, what about you?
I'll go with a buy on Adani ports for targets of around 1250.
Okay, buy on Adani ports. Thanks for that. Well, Amnish Agarwal is still with us. Amnish, you heard the management of Ireda very, very optimistic there. The opportunity size is vast. And they are, sitting at sort of in a sector which is kind of has, the government has a huge focus area in renewable energy. Do you see further upsides in the stock?
You see, the segment is good. The growth opportunity is huge. But in case of, say, all your financials, your growth can be in line with what is the size of the balance sheet. So that is one. Secondly, if you look at the only discomfort here seems to be the price to book, because the stock has run up very sharply in the last, say, month or so. And now it is trading at, I would say, very fancy valuations. I think the valuations apart, the story looks quite interesting to us.
Okay, the valuations apart, the story looks very interesting. Got it. By the way, just before we let you go, Amnish, any thoughts on Axis Bank? Comes out with its numbers later today. After the good showing from ICICI Bank, would you be bullish here?
You see, we are constructive on Axis Bank. The numbers are likely to be, I would say, just an average, because all of the banks, I think this quarter, even if you look at the aggregate, the numbers are not going to be anything great. So based on numbers, I would say it will depend mainly on the granularity of numbers, that how much is the deposit growth and what is the guidance and all. Because as such, in terms of numbers, there is not likely to be any big beat on either side.
Quick comment on Cipla. It's the biggest gainer in the Nifty in pre-open.
See, that is what I said when we were discussing about the stocks, that Cipla is one of the outliers. The company has really done well, both in terms of generic growth, in terms of margins. And I think if I look at even today, it's trading at, say, 22 times FY26, and I believe that post the calls, the numbers are going to be get revised upwards. So I think it continues to look good to me at the current juncture.
Okay, thanks a lot for that. Well, just wanted to point out that Prime Minister Modi's decision to put 1 crore homes that will have solar panels, a lot of these renewable energy companies are doing really well this morning. So whether, we spoke about Ireda, there's also Tata Power, which is up 6%. Borosil Renewables is up almost about 11%. So there's a sentiment bump up that you're seeing across the board here. More on that later. But in the meantime, Mangalam is here to tell us about the bull versus bear argument on Colgate. Mangalam, over to you.
Well, let's start with the bear argument for Colgate, where CLSA says that the beat was led by gross margin and volumes still remain elusive. This is an opportunity that the company could have taken to perhaps, grow volumes in a category at the cost of margins as well. And from here itself, the ability to drive further margin expansion may be limited, which is why they're sellers on the stock with a target price of 2,000. However, Jefferies on the other side says that the strong pricing-led growth indicates their pricing power in the market amidst input cost deflation. At the same time, this would lead to a respectable EPS growth going forward as well, as a result of which they are buyers on the stock with a target price just shy of that 3,000 mark.
All right, thanks a lot for that. We just have about 10 seconds, I think, left for the markets to open. And as I said, in this whole rooftop solar sector where Prime Minister Modi has talked about 1 crore homes to have solar panels. Tata Power is one of the biggest players here, a couple of others as well. More on that in a bit. But here's the first tick on the index. Just look at that go. 21,700 on the Nifty. Massive opening this morning. 145 points higher. The sensex straight off the back is up 500 points. The sentiment is upbeat. Mid-cap index is up 400 points as well. And big movers in individual stocks. We'll talk about that. For now, very, very strong opening for the market. Advanced decline ratio at almost 1,500 stocks on the advancing side. Big mover, Cipla up 5.5% post numbers. ICICI Bank strong numbers there, 3.5%. But the space to be in this morning really is the power and the renewable energy space. Almost everything that has anything to do with renewable energy is surging right now. Tata Power is one of your big movers. And of course, we'll get to the others in a bit. Are there any stocks in the red at all? Yes, a couple of them. So there's HDFC Bank that's slightly subdued. Pharma, so Sun Pharma is slightly on the weaker side. Auto stocks are taking a bit of a breather. Maruti, Bajaj Auto, etc. And Asian Paints is down 1.5%. But stripped of that, it's a solid market opening and there's plenty to pick and choose in this market. Names like IRFC continue to surge. Ireda is up about 5%, very positive commentary from the management. And Tata Power is up about 4% more on that in a bit. But for now, very, very strong numbers.
Well, that's right, Sonia. And a couple of these finances are doing very, very well. IRFC, that's up close to 7.5%. Tourism finance, that as well is flying away up close to around 6% as we speak. So big up move is what you're seeing. REC as well is high with a gain of close to around 5%. Massive move being seen out there. RVNL, that's another stock that's doing very well. So a couple of these PSU themes continue to do well. NHPC had a big surge on Saturday. Well, that continues its up move. So that stock as well is high. I think SCI had a good move on Saturday. I think that one as well had opened up well in the green. So keep an eye out on that one. On the flip side, volumes on the downside, you have Z Media. Well, that one's down close to around 10% as we speak. So big selling pressure out there. Hoodco is under some pressure, so it's down close to around 2% or thereabouts. On the index, a quick word. The Nifty has opened above the 20 DMA, which is good news. And the Nifty Bank has opened above the 50 DMA. So both those two technical barriers getting knocked out in the first 2 minutes itself. Sustaining this is going to be extremely crucial. To run you through a few quick names, Oberoi Realty is down close to around 5%. Some profit taking out there. IDFC First Bank, Abhishek told us that he wasn't too impressed with the numbers that were delivered. So that one's down close to around 5% as well. We'll have the management joining us later on the show. And NBCC, that's up close to around 6%. Prashant.
Okay, well, the market's looking good, isn't it? 21,747. We are past Saturday's high. Saturday's high was about 21,720, and we're about 20 points on top of that, which means that the Nifty at this stage is above the 50% retracement of the two-day fall that we saw in the middle of last week. And the next kind of level, logical level, is a 61.8, which is about 21,804, 805. So that's the index for you. Just a quick look at the Nifty Bank before we kind of look at more stocks. The Nifty Bank is up about 0.8%. Saturday, of course, the Bank Nifty outperformed what the Nifty did. So just a few names here. So the biggest volume-led gainer is ICICI Bank. It's up about 3% at about 1,042. ICICI Bank. Last couple of quarters, post-results, the stock did not do very well. But that's not the case this morning. It's starting higher. IRFC, we mentioned, is up almost 9%. RVNL is up about 7%. Third day in a row. I mean, Friday was a bombastic day for the public sector stocks. Saturday was very powerful. And this morning, this Tuesday, it's starting very strong as well. NHPC is up another 3.5%. Petronet is up about 4.5%. And, Ireda, we just had the management 5% there. Solar Wilson is up 5%. 529, of course. I mean, you've got strong gains there. You've got what else? Non-PSU names, maybe. Look at Tata Power, which is up 3%. You've got Borosil Renewables, which is up about 18%. Let's have that up, please. 597 on Borosil Renewables coming up right now. And we should have the management with us as well. So, we'll try and get them up for you to talk to them about this opportunity, the solar rooftop opportunity. Tourism finance is up 6.5%. 202 tourism finance. Again, I mean, tourism, of course, has been the talk of the town, of course, with that big event in Ayodhya, the Jeffries note, and that is looking up strongly this morning as well. Dhanalakshmi Bank is up 7%. That's a big one. Max Healthcare, the hospital company, is up about 5%, 5.5%. You got IIFL Securities, which is starting about 5% higher. There is KPI Green, which is up about 5.25% as well. And there is Karur Vysya Bank, which is up about 3.5%. It's a pretty solid start all across at this stage. IDFC first reported numbers. It's down 4.5%. You'll hear from the management a little later. Stocks at about, 83, just under 84 rupees. It's got very large volumes for this point in the day. And you got some pullbacks in these PSU names as well. So IRCTC is down 3, Railtel is down 4, and you've got Hoodco, which had a one-way move, which is down about 3% or so as well. What else, Nigel?
But IRFC, you know, that one doesn't buckle down. It's down. It's a 2.5 lakh crore market cap as of now.
Yeah.
It's more valuable than even Coal India. Coal India is 2.47 as of now. It's even more valuable than Nestle. And it's equivalent to Adani Ports as well as Ultratech Cement. Imagine that. You know, just take a look at that stock. Just pull up the last 1 year chart. We'll tell you the picture out there. IRFC more valuable than even Coal India right now. Whoopsie daisy.
It's incredible, right? And let's actually put some of these points to Sanjeev Prasad, Managing Director, Co-Head, Kodak Institutional Equities. Sanjeev, of course, through his notes and his team through his notes over the last couple of months have been sort of, wondering about what's really going on. Right, Sanjeev, good to have you here on CNBC-TV18. I remember that one, you wrote this note and you gave some of these stocks a closer look. And I remember what you wrote on BHEL. I think you did some sort of, DCF calculations, and you said it just doesn't make any sense. So I just want to start with some of these PSU names that we have and the rallies that we are seeing here. Sanjeev, what are your thoughts?
I want to say we don't cover many of these names, but at least BHEL, which we cover, I can give you some flavor of that. So if you look at BHEL, the market cap of that company has increased about 50,000 crores since the beginning of this financial year. It's about 750 billion rupees now. And if you do a reverse math on 500 billion rupees, in terms of what it implies, it basically implies somewhere about 80 gigawatts of incremental order wins for BHEL. It take about 60 billion rupees per gigawatt, 10% PAT margin, which itself is a very high number. So it looks like the market is already assuming that BHEL will something like 80 gigawatts of will get 80 gigawatts incremental order wins and will execute all that today itself. Remember, this 80 gigawatts will get executed over a period of time. So you have to discount that cash flow also adjusted for time, which means that the implied gigawatt is in fact even higher than 80 gigawatt. Just to put it in context, India's current thermal-based coal capacity, generation capacity, about 212 to 15 gigawatts. So that gives you a sense as to what is getting priced in some of these stocks. And I can give you as many examples if you want. If you want, one of the stocks we're discussing, IRFC, about almost $40 billion market cap now. The combined market cap is it's more than the combined market cap of UB and PNB, by the way. And if you look at net worth of IRFC, that was somewhere about 45,000 crores as of end of FY 2023. Combined net worth of UB and PNB as of end FY 2023 was 2 lakh crores, 2 trillion rupees. So that's the context which we are dealing with over here. Clearly, there's a lot of excitement about certain stocks, but I assume that's the mood of the market. I guess many investors have stopped looking at numbers now. Themes are more important than just numbers. So we'll have to deal with it, I guess.
Is the entire are most of the names in that space so egregiously priced, Sanjeev, or are there exceptions? Because at the margin you also get news flow, which opens up new business opportunities which were not there earlier. For example, the solar rooftop thing that we were discussing, the Prime Minister's comments from yesterday, and there is movement, there's new opportunity, etc. as well.
The problem, Prashant, is that nowadays everything floats a narrative. Clearly, the government is doing all the right things will happen in the country over a period of time. But to discount everything today and give back for that today, I don't know how much sense it makes. Fine, India will put up a lot of rooftop solar units over a period of time. But look at the increase in the market cap which has happened just today itself. That really looks something which is discounting a lot of. Sorry, I don't know what's starting to call. Sorry. A lot of incremental capacity will get added today itself. And who knows what is the probability of the business to start with? You know, a lot of excitement around solar cell generation. For example, look at the ROE of solar cell generation. You know, I'm talking about utility projects over there. It comes to about 10-12% ROE, which is not even equal to your cost of equity. So why are we giving value for a business which, if you invest 1 rupee, you will probably get lower than 1 rupee as the logical market cap of that business. So why should incremental value just get created just an announcement? Anyway, as I said, unfortunately, investors are not looking at numbers these days. A lot of focus on narratives, and obviously you can't write a narrative, right? It's like trying to
I got it, Sanjeev, so let's look at numbers, right? Let's, go through the numbers. ICICI Bank, the numbers are looking pretty decent. Asset quality is stable. Things have picked up. Low retail loan growth, almost 22% retail loan growth is what ICICI Bank has reported. How are you feeling about some of these private sector banks, and would you put more money to work here?
Only players will be back in say for some time. There is some value. Based on ICICI result, at least there is some confidence should be back the minds of investors about this whole NIM issue, which has been hotly debated. So if you look at NIM of ICICI Bank, it declined about 10 basis points quarter-to-quarter, about 30 basis points on a yearly basis. I'm talking about the domestic business NIM. So that should give some comfort that whatever concerns people had about the decline in NIMs, etc., that is not really playing out. That was really expected. There would be some decline in NIMs given the fact that the big increase in NIMs in FY 2023. And if you look at our own numbers, we're already building in about a 50 basis point decline in NIMs in FY 2025 compared to FY 2024. So we're already factoring in all this issue that despite that, all these banks are delivering pretty decent numbers in terms of loan growth is anyway quite robust for most of the banks. Are doing about 80-20% loan growth now. And ROEs are in the range of around 15% plus minus for most of the banks. And multiples are actually quite reasonable. So if you look at ICICI Bank,
got it.
All right. About 1 rupee, which is the value of its non-bank business. It is available about 2.5 to 2.6 times, on a very powered basis, which is not too bad in the context of whatever valuations you are seeing for some other sectors at this point in time in the market.
Yes. All right. Hi, Sanjeev. Good morning. Sanjeev, final question before we let you go. Give and take everything, what we have seen in earnings season so far, I think assumptions were for mid-teens earnings growth. Do you think that's at risk, or do you think that's gettable?
Well, see, so far the numbers have not been that great. If you look at the volume numbers of the consumer companies, quite disappointing compared to even the muted expectations that the Sprint had. Whether it is the paint business or toothpaste of Colgate or the broad-based numbers of labor with 2% volume growth, there is a struggle as far as volume growth is concerned. And banks numbers, some disappointment HDFC Bank, which anyway is reflecting in the market price over there. Other banks, I would say, broadly seem to be okay. I'm not talking about other banks, actually. ICICI and KBP among the private banks. Can't comment on quarter, obviously. Reliance was marginally better than our estimate. So yeah, so nothing very shocking in terms of all the surprises, but really some disappointment as far as the consumer sector is concerned. Unfortunately, that trend has continued for the last 4 quarters of really muted consumer demand, which was there in staples, seems to be now there in the discretionary part also.
Okay, all right, Sanjeev, thanks so much for joining in, putting some caution on board as well. We appreciate that. Looking forward to having a chat with you soon. But a good point is you're fairly impressed with the earnings that have been delivered so far. By the way, before we move on, just pull up the mid-cap index. It briefly went into the red. Someone's pulled the chain, I think, on the train, because some of these, train-related, railway-related stocks, they're seeing some intense profit-taking as we speak. Remember, they ran up big time. So that could be one of the reasons why, in fact, some money being taken off the table. IRCON, RVNL, all of them, IRFC now as well, has taken a U-turn. So some of these stocks should come up for you on the screen. But let's talk about the IT pack. Coforge reported a decent set of numbers. Revenue growth came in ahead of street expectations. The company has also maintained its constant currency revenue growth guidance of around 13 to around 16%. Sudhir Singh, CEO and ED of Coforge, joins us on the show. Hi, Sudhir. Good morning.
Numbers look fairly good, Sudhir, and you stick to that guidance of 13 to 16%. What's it likely to drift towards, the upper end or the lower end? Point number one. Point number two, margins came in at around 18%. You were telling us that margins in FY24 will be similar to FY23, which will be around 18.5%. Stick to that as well?
Absolutely. So let me start off with the revenue. We are possibly one of the very few, if not the only firm that gave a very clear revenue band guidance at the beginning of the year and is talking about, and we are sure we are going to achieve that number. At the end of the first 3 quarters, cumulatively, we are growing 14.7% over the first 3 quarters of last year, and hence the confidence around maintaining that, delivering upon the revenue guidance that was given right at the beginning of the year, 13 to 16%. We talked about it yesterday, and we feel confident that that's a guidance that we will deliver upon. As far as margins are concerned, again, the guidance at the beginning of the year was that we shall deliver margins around the same level as last year, and we still maintain that. As far as we are concerned, we believe Q4 is likely to see a very significant uptick on the adjusted EBITDA front and the EBITDA front. And therefore, with that uptick, we believe that the overall annual guidance will stay.
But what about the revenue growth guidance, Sudhir? I want to know whether you're drifting towards the upper end, which will be 16%, or the lower end, 13%. It's a given that you're going to be achieving this band now, and you're sounding very confident, and you sounded like that even in the past quarter. But which side should we be drifting towards, the upper end?
Well, we talked about it yesterday on the investor call as well. We will be somewhere around the lower end of the guidance, but the important thing that I want to accentuate once again is possibly the only firm that gave a guidance, has held on to the guidance, and will meet the guidance.
Okay. Mr. Singh, hi, good morning, and thanks for joining in. I wanted to understand from your end, how is discretionary spending right now? Have you seen any pickup at all? And what are clients saying about budgets for 2024? Is it going to be, worse than what we saw in the previous year? Some indication of how things are on the ground?
Well, the demand macro continues to be tough, and I suspect it's likely going to continue more or less in the same holding pattern for the coming quarters. Budgets for most of the enterprise clients have already been finalized. They're locked and loaded. And when we look at a grounds-up view in terms of numbers that we are seeing, budgets that are being talked about, there's really nothing in the short to medium term that indicates that demand is going to see a material uptick. I believe, we believe as a firm, that one has to plan in that context, and the manner in which we've clawed out growth this year with depressed macros is the manner in which we will have to operate for the bulk of FY25 as well.
Okay, so you're saying that demand macro continues to be tough, and there is no reason to believe that there'll be a material uptick. Would that also mean that certain segments, like say insurance, for example, where you've seen a little bit of pressure, will continue to be weak even over the next couple of quarters as well?
Insurance actually has done fairly well for us. At the end of the first 3 quarters, insurance is growing 11.5% YTD in CC terms. We believe insurance, banking, travel, and public sector, which are now the 4 core verticals of the organization, all of them are likely to be fairly similar in terms of growth that we will record over the coming quarters and the coming year.
Mr. Singh, we're still talking about FY24. I don't know if I can nudge you to talk about FY25, or is too far out. What are your thoughts, sir? I mean, as you say, this is the year. I mean, if the US has got to see any slowdown, it'll be this year. Or maybe it'll just glide through, and there'll be no soft landing or anything, and it'll be much better. Economists are expecting that the economy should be fine shape by the end of it, but you never know. So how do you think about FY25 as a year? Because, as you said, budgets have been finalized, locked and loaded, so you'll have some sense.
Well, I mean, we're really not seeing the demand situation changing materially at all in FY25. Therefore, at an industry level, one should expect growth numbers, which will also broadly be in line with FY24 numbers. Of course, as an industry, one will always have outliers, both on the positive and the negative side. But at this stage, there's absolutely no reason to believe, looking at the enterprise budgets and the manner in which they've already been closed for demand to be reversing or seeing a material uptick anytime soon.
So FY25 also, I mean, again, not a formal guidance, but around that 30-odd% growth level, right? In terms of what you're expecting in 23, around those levels.
Yeah, we'll offer a guidance. We'll offer a guidance at the end of the next quarter. Normally, our annual guidance comes in at the beginning of the year, and that's when we'll offer it.
Okay, all right. Sudhir, I wanted to ask you also about the finance costs. It went up a little bit. You know, you were looking at restructuring some part of the debt. I think it came in at around 35 crores, the finance cost for the past quarter, which compares with around 22 crores. What's the updated number in terms of debt, and how do you see this restructuring going ahead?
So we really don't see the finance cost being a material drag on the firm. The numbers that we've seen in the past have allowed us to deliver the EBITDA and the PAT that we have. Our belief is next year EBITDA should see a positive uptick compared to FY24. Revenue, I've already shared an update in terms of where we are. So finance costs that have been largely because of interest rate costs on account of working capital are likely to ebb away as the quarters progress.
Your order intake in and around has been in and around that $350 million mark, right? Give and take 5% here and there. Is the deal velocity going to be like this over the next few quarters as well?
We feel pretty good about the deal velocity. When we look at the pipeline that we have, the fishnet that we have in terms of the deals in play right now, we think deal velocity should sustain. In the first 3 quarters, we've closed 8 large deals, 3 in the last quarter, quarter 3, which is a seasonally weak and a shorter quarter. So deal velocity should sustain, and that is why we believe even if the macros are going to be depressed, and I believe that's highly likely, we should still be able to clock growth as we've been able to do this year as well.
And is there any investments, fresh investments that you're making in the generative AI space? A lot of your peers are doing that, and that is the buzzword now. What's the opportunity looking like for Coforge?
It's significant. It's significant, and we've been investing now for almost 3 years in the AI space, almost 3 quarters now, very specifically within Gen AI as well. We launched our own proprietary AI platform, Gen AI-based platform, Quasar. And what's becoming very apparent is it's not just the net new revenue, the net new services that Gen AI and AI is influencing. It's also very, very strongly influencing the ability for us to reimagine and to deliver existing services, whether that's next-gen ADM, whether that's product engineering, whether that's even BPS services. So to that extent, investments have been significantly prioritized. And the next year budget planning that we've done, almost 40% of the incremental investments that we will do next year will be in the AI space itself.
All right. Well, thanks a lot for joining in, and all the best in some of these new areas like generative AI. That's Coforge. They've maintained their revenue guidance at 13 to 16% for FY24, but they also say that the demand environment continues to be quite tough, and there's no reason to believe that there will be a material uptick in demand. That's important. Let's slip into a quick break. On the other side of the break, Suresh Srinivasan of Canfin Homes will be joining in for their Q3 earnings. Also, V. Vaidyanathan of IDFC First Bank will join in to put focus on their Q3 performance. Stay tuned.
Co-presented by
Okay, welcome back. I mean, the market's up 135 points, 21,700. So once again, we are knocking and debating around that 21,700 level, just under that, which is the first resistance which we've been putting out for the last 2 or 3 days. It is a 50% retracement of the fall. The high today is a higher high as compared to what we saw on Saturday. Saturday was a higher high as compared to Friday. But the fact is we're not being able to clear this in a convincing kind of way. But this is initial first hour or so, and we'll have to watch this closely. Canfin Homes is the company in focus, and we've got the management joining us to talk about the numbers. Net interest margins have come in at a 7-quarter high. Asset quality, though, has taken a hit from the restructured book. We have Mr. Suresh Srinivasan Iyer, Managing Director and CEO at Canfin Homes. Mr. Iyer, good to have you with us here. Thank you very much for your time. Could you talk to us about asset quality, sir? How much of this hit has come from the restructured book? Just break it down for us a little bit.
Sure. See, our gross NPA has come at around 0.91%, which in absolute terms is around 308 crores. And if you have to break it up, about 96 crores is because of the restructured book. And at the beginning of the year itself, we had kind of indicated that in the restructured book, we are having a slight pain to the extent of about 15%. And this 96 crores is in line with the estimate because we had about 670 crores of restructured book. And the good part is that the entire book has already come out of restructuring in November. So going forward, we don't expect any further pain coming from the restructured book. And as the efforts on the legal side and recovery side is going on, we should see some recoveries coming from the restructured book as well going forward.
Could you put some numbers to it, Mr. Iyer? What kind of repayments?
See, you're talking about regular repayments. We have about monthly collections of 700, but
if you're talking about the
recovery from the restructured book, we should probably, we are expecting around 20-30 crore of gross NPA to come down in the fourth quarter.
Okay. All right. Hi, Mr. Iyer. Good morning and good to see you in. Well, there were some disruptions in disbursements in the last quarter, because of the entire transformation that you were undergoing. And that's why, in fact, it came in sub that 2,000 crore mark out. For quarter four, do you see it return back to that 2,500 crores in the subsequent quarters? Can it go to around 3,000 crores? That's on disbursement. And what is the AUM growth outlook for this year now? Earlier, we were guiding for high teens. It was scaled down to mid-teens. I think the last number you're talking about is around 13%. So give us that outlook for FY24 and FY25.
Sure. See, in the first month, that is October, we had some, transition issues because of which our disbursement was quite subdued. But going forward now, as you closer to December and all, we're back to the run rate of about 700 crores. That's about 2,100 crores any which ways. And we are expecting that, the Q4 is generally better and March, the final push always comes. So around 2,500 is something we can expect, as you were saying. And once everything settles down, definitely we should look at about 3,000 crores in the next year. So for next year, we are definitely planning around 3,000 crores a quarter, which is about 12,000 crores for the year. So in terms of the next year growth, we should see about 20% kind of a growth in terms of disbursement from the current year figure. In terms of the loan book, yes, you're right. We are right now around 13 and we would continue to, project a 13 to 14% for the current year, considering that we are already a little negative. But in terms of the housing portfolio or the business as such, we are quite upbeat still. And the demand has also been up. So we expect that, at least going forward, we should be back once we are stable on the operational front. We should be back on the, 15% plus, closer to 18% kind of a growth in the next year in terms of our AUM.
Growth. AUM growth of 15 to 18% in the next year, in FY25 is what you're looking at. Got it. On the net interest margin front, it's hit almost at 3.92%, which is a 7-quarter high. Do you think you can build on to this? And what is the average NIMs that you're looking at in FY25?
See, this increase in NIM has been mainly because we had our asset side, which was getting repriced because of the interest rate hikes. And because we had a lag effect because of annual reset clause, that's why we've had a prolonged effect. But again, on the reset also, we've almost concluded the entire portfolio, which was to be reset, has already gone through the reset. Going forward, there is no upside from here. And since we are also looking at a slightly higher ticket size and would be offering some attractive rates, so I think, a 3.5% plus can definitely would sustain. But we would kind of give a guidance of not more of about 3.5.
3.5% is what you'll hold on to in FY25, correct?
That's right.
3.5
NIM and 2.5 spread is what we would like to give for next year.
Okay. And the return ratios, what is the outlook on that? Is it something that you can sustain in FY25?
Sorry, can you, in terms of the?
What is the outlook in terms of your return ratios?
In terms of our return, see, we're back to a 2.3 for the quarter in terms of our ROA. And so a 2.1 kind of a ROA for the entire of next year is something we can we feel is sustainable, and therefore that would work to somewhere in the range of about 18% of ROE.
Okay, Mr. Iyer, one read through from your results apparently is that on the affordable side, there is a bit of a demand-supply mismatch. There isn't enough supply. Something we've discussed with other companies out there as well. So you're kind of going into slightly higher ticket loan segment. Is that correct, and is that going to be the shape of things to come?
Yes, we are looking at a slight improvement in our ticket sizes because affordable housing, particularly after the CLSS closure, has slightly been a little affected, I feel. And therefore, from our side, even considering that we have been in the mid-20s kind of an average ticket size, moving up would be a better thing rather than going down in the ticket size, because that would require a different segment to be targeted. So considering that our strength is in the salaried segment in terms of the mid-size segment, it would be probably better to move up in the ticket sizes.
Okay. So you're around the 20 lakh sort of ticket size. Move up to what, Mr. Iyer?
We are looking at around up to 30 lakhs for the from 25 in the next 2 years. We would like to touch about closer to 28-30 lakhs.
Got it. All right, Mr. Iyer, you have lowered your dependency on DSA, which is direct selling agents. How do you see this panning out going ahead? If you could give us a percentage, where do you see it stabilizing at?
See, it's not that we have reduced on our DSAs. It's just that we are now also, trying to broad base our sourcing model and our channels, and therefore are pushing more for direct sourcing as well. So right now we have about, in the beginning of the year, we had 85% sourcing coming from the DSA channel, which is for this quarter down to 79%. And in the next 2 years, we would definitely like to have the mix around 60-40, 60% coming from the DSA and 40 from the direct or from the digital channel.
All right, we'll leave it at that. Mr. Srinivasan, thanks a lot for joining in, and all the best, going forward as well. That's Canfin Homes. By the way, the stock of the moment is Persistent Systems. Just look at that, 10% higher now on Persistent Systems on the back of the numbers that have come through, revenue growth, margin improvement. In fact, HSBC has upgraded Persistent Systems to a buy. They've raised their target price to 9,875, which is a big upside to the current market price. So Persistent Systems surging away on the back of that.
I mean, very few companies, right, in the IT service. Persistent is one, Cyient is another, where growth is, higher than where it was pre-COVID. Otherwise, across IT companies, I mean, growth rates are in some cases slightly, and in most cases meaningfully below, the pre-COVID levels that we had seen. Persistent once again beating. Of course, Rima explained those numbers pre-market, saying another quarter of beat. The stock is following up. Cyient is, of course, down about 2.5%.
Just one word, Prashant, on the index, the Nifty Bank, the 50 DMA that got breached in early morning trade. That's we couldn't hold above those levels.
Yeah.
So that's one point. And from the broader markets, we're talking about some of these themes that are playing out. The railway stocks are coming for profit taking, but it looks like the ship is taken off because the SCI is now at a 52-week high, massive volumes in the first 10-15 minutes or so, and that's nearly 200 rupees odd. It's seeing a follow-through session actually. SCI had a big session on Saturday, and today as well. Volumes are massive. That's more than, I think, almost the daily volumes that we've seen just in the first 10-15 minutes.
Absolutely. Actually, maybe we can pull these intradays up on the rail side where there's profit booking. IRCON, if you can have these up 8% lower, massive volumes on IRCON. RVNL is down about 5% or so. IRCTC is down about 3%. These are all top volume traded across the NSE. RailTel is down 8.5%. Sharp cut. There is RITES, which is down 4.5%. Texmaco Rail is down about 5.5%. So this entire pack coming in for profit booking. The standalone refiners is another pack. Chennai Petro, and Nimesh did that piece on Editors Roundtable a week back. Chennai Petro is now trading at some, I think, 8 or 9 times earnings as compared to the 2 or 3 times earnings it usually historically traded at. I mean, that struck with me. 8% lower on Chennai Petro, 780 on that one. And there is MRPL, which is also coming in for some profit booking. It's down about, pulling back about 4.5% or so. These are pullbacks after what has been absolutely massive seller rallies. So on a longer term kind of chart, these would look like blips, unless, of course, it continues for a bit longer. But for now, it is just this morning. Sonia.
Also, Oberoi Realty, by the way, the numbers, look at that. The stock is down 6% right now after the pre-sales are down almost 20% quarter on quarter. So lots of, dramatic movements in stocks. But Cipla is the one that's topping the charts this morning. Ekta is here to tell us why. Ekta, over to you.
Thanks for that. Well, yes, definitely a good set of numbers. It surprised the street on the upside. So revenue was up almost 14%. The street was anticipating around 11% growth. Now, the margins were the key highlight because they came in at the highest level that we've seen at least in multiple quarters, if not a record high for Cipla in terms of margins. So 26.5% is what they reported. The street was anticipating 23.8% and a come off on a Q-on-Q basis, which didn't come through. Profit also supported this quarter because of the operational performance, despite an impairment of 195 odd crores. Now, the US sales stood out. $230 million is what they recorded. It was versus $229 million in the previous quarter versus estimates of $218 to $225 million overall. So it definitely beat estimates. And it was the 15th consecutive quarter of growth for the US sales, highest ever sales for the US by Cipla. Obviously supported by Revlimid generic, but they also indicated that the base business is doing well. India up 11.6% year on year. It was the third consecutive growth for India business for Cipla this time round. International markets, API was flat, but it seems on a Q-on-Q basis, but it seems as though the street has shrugged it off. Also, the cash in books is over 7,000 odd crores for Cipla, despite paying off a loan in South Africa. So it seems as though it's really firing on all cylinders. Revlimid generic is doing wonders for them. These numbers have come in despite them having US FDA issues in a couple of their facilities such as Goa and Indore. So the street likes what it sees. It's trading at around 23 times 1 year forward.
All right, Ekta, thanks a lot for that. Well, IDFC First Bank is in focus. The net interest margins came in at a record high. Retail loans were strong as well. V. Vaidyanathan, the MD and CEO of IDFC First Bank, is joining in. Lata is also here in the studio to take us through that interview. Lata, over to you.
Thank you very much, Sonia. Mr. Vaidyanathan, congratulations to strong advances and deposit growth as well. Retail on both advances and deposits doing very well for you. So, I mean, I'm just playing devil's advocate. Let me start with what is the street. The margins have risen despite it falling for everyone else. So, I mean, there's just a worry. What is your cost of funds and what is the yield on advances that gives you such strong margins?
We discussed this last time, Lata, but I'll repeat it. Our cost of funds this year, this quarter went up to 6.2%. Last time it was 6.1%, went up by about 10 basis points. But at the same time, we dropped our savings rates from 4% to 3% on the 0 to 1 bucket. That also cushioned things a little bit. But overall, we think that these are risk-adjusted margins, and our credit cost continues to be quite strong and stable. So really, we're really looking forward to expand this model in the next 3-4 quarters, and people will see meaningful improvement. I think the concern, if I may put it so, is not so much in the name from what we hear, but people are concerned about the fact that our cost-income ratio did not improve, and our OPEX a little higher.
Okay. No, I am coming to the cost to income, which is high, in fact, gone higher a bit. But before that, you know, the logical doubt is that if you have such high margins, 6.4, that perhaps means that you are, lending to high risk, high return borrowers. And that is also reflected in the fact that your slippages are high. I mean, 3%, 3.07% annualized slippages is higher than most good banks.
No, we went through the same discussion last time. You have a long memory. I don't know why you're forgetting. Same discussion, we spent full 10 minutes on this, okay? There are three important criteria to measure credit quality, and we are acing all three of them: gross NPA, net NPA, and credit cost. Now, on credit cost front, we are trending at about 1.3%. We guide for 1.5. For this portfolio, for any portfolio, if you even take one of India's best banks, which has been growing at 30% for maybe 25 years for 30 years until slow down, even their credit cost has been quite, running at about maybe 1.5, 1.6% for a long periods of time. So therefore, 1.5 is a good benchmark. We are going below that benchmark. Our NPA is 1.45%, Lata. Our net NPA is 0.5%. So don't come prejudiced on these numbers. This is the way the model works, and it's behaving well for 14 years. By the way, 14 years is like a Raman vast time. So we've just...
I mean, no quarrel at all. I began by congratulating you on the fact that many of the ratios are positive. But why are slippages high? I mean, why is it at 3%? And when would you see that fall?
No, Lata, you should see the net slippage, because in the nature of the portfolio, some gross comes, some net comes. As far as our credit cost stays 1.4%, it is absolutely fine. You need to get and you meaning, I mean, even others who are observing the program, you will get to see this play out over a period of time. So you should see credit cost. Credit cost is what provisions we take. And that is running 1.3. 1.3 is a good number.
Yes. No, I don't deny that. It's just that one worries that is it a high risk, high return kind of design that you have, and whether that might lead to problems later on.
No, Lata, like 14 is a long time, so please get used to this. And secondly, it is not high risk, high return. You should call it high risk if credit cost was high. If NPA was high, net NPA was high, credit cost was high, nothing is high. How can you call it a high risk model? It's just a specialization. It's a specialization we have, and we should appreciate we are able to lend to a particular segment in a very low risk model with a low credit cost. I think we should get used to this.
Okay. No, I'm sure a lot of people are. Your stock has done very well. I'm just asking you the skeptics question. When you see very high yield on loans, that becomes a logical question. Okay, now let's come to the cost to income. Yeah. Now let's come to the cost to income. Yeah.
Let me clarify, by the way, Lata, that you should. Let me just make it. You should ask your questions so that you feel comfortable.
Okay. Yeah. No, I mean, it's important that skeptics out there get your side. Get the rationale as to why, your GNPAs, there are so many metrics on which your asset quality is good, and that needs to come out as well. Cost to income, now 73% is really high. What explains that, and when do you see that coming down? Because that tells on other margins like ROA, etc.
Yes. See, Lata, everybody knows very well that this is a setup stage bank. This is a DFI. Don't forget, this is a DFI converting to a bank. So DFI with a 75,000 crore loan book, you got to replace it. The whole deposits, from bulk deposits, corporate deposits, paying off bonds, everything is being funded by retail money. How does retail money come? Retail money comes when you put up a deposit franchise. How does a deposit franchise? Your branches, ATMs, technology, people, everything is coming up. So this is a setup stage bank. So our thing is very simple, that this is a stage of the bank. When you look forward, even 1 year ahead, just to give you a picture, we feel that things will look better, and the numbers will play out as they come.
Okay. Well, any guidance you can give on where cost to income and ROA may look a year down the line, 2 years down the line?
Let's talk. Say Q3 25 and Q4 25, because that's you can.
Yeah,
it's
fair enough.
In horizon. So we feel that in that window, what next year something important to play out at the bank. We feel that our OPEX as OPEX growth will be just about 20%. Traditionally, we've been growing at about 33% because we were setting up. Now it will grow by 20%. We feel that number because we are already originating 50,000 crores a year from our deposit franchise. Since we are slowing down the loan book, it is easy to fund that now. So we feel that next year our deposit will grow the expense will grow by 20%, income will grow by about 25%. So by Q3, Q4, you should see meaningful improvement.
Fair point. Yeah, I was going to say that your OPEX per branch is much higher. I mean, about 2-3 times what it is for a Federal or a IndusInd. I mean, I'm not comparing it to the older banks, but yes, okay, your point is that you're just setting it up and that's why it's high.
It's an early stage bank, Lata. We should not forget that.
Yes, it's early stage in some ways and late stage DFI in other ways. You refer to the fact that now that you are lowering your loan growth, is this something that the Reserve Bank has advised? I mean, they're telling all banks to lower their credit deposit ratio. So is that why even in your investor presentation, I noticed that you have lowered your loan growth target from 24% to 20%. Can you explain that?
We will not change the target for this year. So in the sense that we're already growing at 24.5.
No, the long-term target, yeah.
Exactly. So now we're guiding for the next 5 years to compound only at 20, because yes, we are reading the signals from the marketplace. We're reading the signals from the market, from the regulator, that we should be very careful. And we really want to be careful. For us, our gross NPA of 1.5, net NPA of 0.5, and credit cost of 1.5 is a badge of honor. Is a badge of honor holding for 14 years. So we don't want to let go of it. So therefore, to be a little safe and for us to be safe and continue this badge of honor is more important. And frankly, whether we go at 20 or 21 or 22, whatever the market affords us. If we can do better, we'll do better. But our intent is to go at that rate.
Fair point, Mr. Vaidyanathan. The questions are, from a skeptic, only because there will be skeptics out there, but many congratulations for a very good number in terms of advances, loans, profits, NII. Many congratulations. Thank you very much.
I want to share one last number before you sign off, Lata, because some viewers may not have this perspective. Of our total expenses, because a cost-income ratio is always under the look, of our total expenses, close to about 30% is employee expenses, about 22%. 22% is what we pay for DSAs and direct marketing agents, etc. That should taper off now because we're originating from the branches. About close to another 22% is pure variable expenses, and close to about 7 or 8% is marketing, etc., marketing and infrastructure, etc. So this is a broad breakup of our expenses. We feel that we will get to see the leverage play out over the next 5 years. The most important thing, we're guiding for a return on equity improvement by 2025. We're guiding for the following bank. Gross, loan book of about 5 lakh crore, deposit of about 6 lakh crore, and ROE of about 17-18, and ROA of 2%. This is a broad picture people should look forward to. I feel such a bank will be quite, hopefully will be well valued.
Look forward, sir. Look forward. Thank you very much indeed for joining us.
Thank you very much.
All right, that is IDFC First Bank. But let's move on. The stock of the moment is Persistent Systems. It's up over 10% after reporting a strong Q3 FY24 earnings. Margins expanded while the BFS revenue declined. We're joined by Sandeep Kalra, the CEO of Persistent Systems. Sandeep, Q3 was strong. How is Q4 shaping up? Will it be better than Q3?
So first of all, thank you for having me. Let me just start by giving a few highlights of the quarter, and then I can come to what you asked for. So from a quarterly perspective, we delivered $300.55 million. This represents a 3% quarter-on-quarter and 13.7% sequential, 13.7% year-on-year growth in dollar terms. Now, a few other highlights for the quarter before I dig into the future part of it. From an overall perspective, look, we also announced a dividend of 32 rupees per share, and the board of directors recommended a stock split. So those are the other highlights of the quarter that I want to put forth before getting into the details. Now, from a forward-looking perspective, look, you're aware we don't give forward-looking guidance. But if you look at the numbers in terms of order book that we announced a pretty healthy order book. This was the first time we had order book in excess of $500 million. The total contract value for the quarter came in at $521.4 million. And this is the first time that $500 million has been crossed for us. Now, this has been a series of quarters where we have done good order books. And even if you look at our last several quarters, the ramp up that we are seeing for the new order book is what is driving our growth. So that should give you enough data points for determining where the future is.
Well, Sandeep, you spoke about green shoots in discretionary spending. Could you talk a little bit about that?
Yeah, so overall, if you look at it today, we are involved in many different kinds of businesses. So on one side, we are helping our customers do programs that are revenue enhancement. On the other side, cost containment. And there's a lot of buzz around AI, generative AI, and those kind of things. So what we are seeing in our customer base is a cautious approach to the newer year. They are also very hopeful that as the Fed has a monetary policy that eases up, they would also see better business on their side. So we are seeing some amount of relief, but I do think it'll be 2 to 3 quarters before we can see the discretionary spend pick up. So far, our revenue growth is on large deals, which are proactive, revenue enhancement, cost containment.
Well, speaking about the buzz around generative AI, you're saying that Gen AI can be a $100 million business over the next 3 years. What's gone into this forecast of yours?
So, Rima, that was a question asked on the call, whether generative AI can be a $100 million business over the next 3 years. So the answer there is, look, generative AI is at the tip of spear. So if somebody has to do generative AI implementation across an enterprise, outside of doing a small proof of concept, you need to do a lot more things in terms of having a clean data pipeline. So that spawns off new projects on the data side and so on. So if you look at the entire stack that is required for someone to implement Gen AI successfully, yes, it can absolutely leveraging the various capabilities we have at Persistent in terms of our data and AI capabilities, in terms of our software development capabilities, integration capabilities, and so on. Absolutely, it can spawn off $100 million business and more over the next several years.
Oh, interesting. All right. But what led to the decline in BFS revenue? And more importantly, has BFS bottomed out?
Right. So from our perspective, yes, the degrowth in BFSI was primarily on account of furloughs, and that should see a comeback from a furlough not being there in the Q4 part of it. And, overall, the order book also supports a healthy trend going forward. So, yeah, you're right in saying what you said.
Okay. So you're saying that the BFS segment has bottomed out, correct?
So it's kind of, bottomed out. How far it goes in terms of the growth going ahead, that we'll have to wait for the next few quarters to pan out.
All right, final question then from my end. What drove the margin expansion, and what will help you achieve that 200 to 300 basis points of margin expansion in the next 2 to 3 years?
Sure. So as far as this quarter gone by is concerned, so there was a few levers like the travel cost not being there, the utilization going up, and so on. So those are the things that added to the margin improvement for us, and that was about a 80 basis points margin improvement. Now, if we look at the next several years, we have said our aspiration is to improve the margins by 200 to 300 basis points. To give you some more data points, on the utilization front as an organization, today we are at 81.5%. If we were to bifurcate the utilization for laterals versus the freshers that we intake, that we have taken in over the last 2 years, the lateral utilization already at the company level is at 85%. So as we bring the others up to the same level over the next year, 2, 3, there is a good lever right there. Our sales and marketing spend today, the SG&A spend, if I compare 9 months of this year to 9 months of last year, we are at least 50 basis points above what we were last year in percentage terms. So from that perspective, when the economy was not doing well, we over-invested in sales and marketing and related expenses, and that should also give us a leverage as the market comes back. Like that, there is significant investment in capability build, in leadership hire that we've done in the last 1 to 2 quarters, and that should all pan out in terms of performance and give us the leverage for the margin improvement over the next several years.
Okay, all right. Hopefully your new order book will continue to provide the kind of growth, trajectory that you're seeing already, and all the best for that. That's Persistent Systems 8% higher now. By the way, MediAssist has just listed, so let's get the stock going as well. It's a third-party insurance administrator, MediAssist, and the stock is up almost 15.5% right now. It processes, a lot of us must have used it actually. It processes health insurance claims on behalf of insurance companies, and that stock is up almost about 17%. The company has tie-ups with almost 19,000 hospitals, and the business has been growing as well. But this is a pure OFS, so the promoters are selling, and a lot of the promoters will be selling 2.1 crore shares out of the 2.8 crore shares on offer. So keep an eye out on that. But that's a good listing coming through from MediAssist. Let's dip into a quick break. On the other side of the break, good day for the market. Mitesh Thakur will join in for some technical trades. Stay tuned. All right, it has started to get very volatile in the market. The Bank Nifty is actually in the red now, down about 90 odd points. And the mid-cap index straight off the back has now fallen about 300 points. So very, very volatile. Just pull up the mid-cap index for you. Look at that at the low point of trade. Mitesh Thakur is joining in. Mitesh, this is some sort of anti-climax, right? In the last half an hour, sort of taken a turn for the worse. But be that as it may, HDFC Bank is the big laggard. It's at a fresh 52-week low this morning. How are you feeling about that? And what are the charts that you're looking at this morning?
Yeah. So a couple of things. I've been maintaining that we'll do a range-bound consolidation and we'll have bouts of buying and selling. I think the early morning high was closer to 21,750, which has been the upper end of the range. And we just trying to come off from that. Maybe we'll head towards the lower end of the range in the coming few days. So it will be choppy. It will be volatile, but nothing very, very negative. I think the only bright side here is the IT stocks. I think that still look good to me. That, but I think the market will chop around, so you'll have to get this, periods of buying and selling. On the stock side, I have a sell on L&T Finance. I think that's a stock which is giving a minor breakdown on the intraday chart, so could give a pullback. Keep a stop about levels of 166.5. Look for targets of around 156, 155 on the downside. And on the long side, I have a buy on Persistent Systems with a stop below 8,300 for targets of 8,650.
Okay, all right. Persistent Systems, despite the kind of move we've seen, you have a buy. That's great to hear. Thanks a lot for that. So those are some technical ideas, but all the solar-related stocks, solar energy-related stocks are buzzing away. Sonal is here to tell us why. Sonal, over to you.
Thank you so much for that. Well, these stocks are in focus because after the big event in Ayodhya, the Prime Minister has announced a new scheme which will be called Pradhan Mantri Suryodaya Yojana, which will have a target of installing rooftop solar on 1 crore houses. Now, that's a big number, and I'll give you a context of how many are seeing this particular installations right now. So the stocks like REC, Adani Green, Tata Power, Repsol Solar, Sterling and Wilson Solar, there's Vari Renewables Energy, there's Surana Solar, Borosil Renewables, which is a big gainer right now. All these stocks will be on our radar now. Now, in India, both rural and urban, they have massive potential when it comes to the installation of rooftop solar. This is according to a CEEW report. They say that Indian households can technically deploy more than 640 gigawatt of rooftop solar, and currently only 7 to 8 lakh houses have this installation. So that means there is a possibility of increasing it by 12 to 14 times because of the target that is given by Prime Minister Modi. And this would lead to an additional 20 to 25 gigawatt of installation in the solar rooftop capacity. This will not only help states save on electricity, but will also contribute to improving the power discoms financial health. So it is good for the power sector, the renewable power capacity addition that we are talking about, and that's why all these stocks are excited in trade today.
Okay, thanks a lot for that, Sonal. Well, let's slip into a quick break. On the other side, Lata will get chatting with Suman Katpalia of IndusInd Bank. Came out with a good set of numbers. More on their Q3 earnings coming up.
Co-powered by
Well, IndusInd Bank reported a steady Q3 numbers. The slippages were the only point of contention in the bank. Otherwise, very strong NII growth and profits and margins, something that the street liked. Joining me now is Suman Katpalia, the Managing Director and CEO of IndusInd Bank. Suman, thank you very much indeed for joining us. Very good growth in margins. I mean, the fact that the margins were flat has surprised a lot of people. Can you tell us how things will pan out? Because there is a war out there for deposits.
Yeah, absolutely. Good morning, Lata. And you're absolutely right. I think we've been able to maintain our margins. If you look at for the last 4 quarters, we've been at 4.2 to 4.3. And we continue to give that guidance that we will be between 4.2 to 4.3. Our margins have been steady at 4.29. And I think we have a lot of levers. I think it's the mix change in our between corporate and retail, number one. And within retail, we have a mix change between microfinance, vehicle finance, and the other assets. So I think that's what has helped us maintain the margins. And also, we also believe that our cost of deposits and cost of funds, which were growing very rapidly, have now slowed down, and it's only grown by 9 basis points. And we believe that we should be able to manage that as we go along. And I think maybe another quarter of growth, and then you should see a steady cost of funds as we go forward.
Okay. Well, since you know at least a few weeks of the current quarter, can you tell us whether the cost of deposits, cost of funds will rise a bit? By how much might it rise? After all, RBI is still on a tight policy mode, tight finance mode.
So I think as long as there is a migration of deposits to term deposits, I think the cost of deposits will see a rise. I think how we manage it is because of cost of funds, and I think we have a very significant way because of our borrowings where we get refinance from developmental associations, and we are able to manage our cost of funds in a better way. And I think we have long-term funds which come at very attractive cost because of the portfolios which we have. So I think while there may be an increase this quarter, I think you will only see stabilization of that as we move forward.
Okay. Well, now let me come to the only other problem that your investors may have with you, and that is slippages. That was elevated, 2.6% annualized and higher quarter on quarter as well. Can you guide something about slippages for the current and next quarter, likely to come down, stay there?
So Radha, first of all, our guidance has always been on credit cost. And if you look at our credit cost, the credit cost has come down from 157 basis points to 119 basis points. So we are well in line with our guidance on the credit cost between 110 basis points to 130. Of course, during the quarter, intra-quarter or within the year, there may be some quarters where you will see elevated gross flows. That doesn't mean our credit cost will change. We've already seen our gross flows coming down for this quarter, and I think you would see the gross flows coming down dramatically and within the range bound which we've been between 1100 to 1400, and that's what we will be in the gross flows. And I think our credit cost will always be between 110 to 130 basis points.
Okay. No, the credit cost was also managed because you used up the contingency buffer. Without that, it could have gone higher, and that's why I'm asking. Now you don't have that buffer anymore. So, how will the subsequent quarters behave? Will you still be able to control?
So we have still got the buffer.
Go ahead.
So our credit cost will be within the range of 110 to 130. We still have the contingency buffer. We've been saying that one of the stressed accounts where we have provided will get released, and I think we will use that contingency buffer as a buffer and keep it aside for ourselves in the long run. But we still have the buffer of 1300 crores. So to say that we don't have the buffer, and we are still provided at 2.22% of the loan book. Having said that, I agree that the gross flows should come down, and I think the gross flows came in from vehicle finance, and I think you're already seeing a recovery in the vehicle finance. It came from two areas. One is the south and the other is the north. North because of the freight movement because of fog, and in the south because of some flood situation. But I think we're already seeing a recovery there. I think the agri piece, it's a seasonal cyclical view, and we are seeing that recovery also happening. So I think you should see us down dramatically this quarter on the gross flows, and we should settle down at the gross flows of about 1100 to 1300 and a credit cost between 800 to 900 crores as we move forward.
Okay. Can you just guide on margins? 4.29 is doable, or it gets chipped off a bit?
I've always said it'll be 4.2 to 4.3. Very difficult to give a number to a margin because it depends on your cost of funds and the yields and how the mix progresses. So we've always said it will be between 4.2 to 4.3. If any historical trend is to go by, we've always maintained above 4.25%.
Okay, no, I mean 4.2 to 4.3 is as good a guidance as any investor can want. No one wants the second decimal point. Okay, can you talk to us about MFIs? Did they give you any problems, your microfinance unit, or was it all rosy? Because some other standalone MFIs have not done too well. Results came over the weekend. How's yours doing?
So our MFI business continues to grow, and I think we've diversified the business. So if you look at our business now, 85% of our book is JLG, which is the joint liability group, and 15% is merchant acquiring, where we have a 4,700 crore book, which is the small merchant acquiring business which we've created, and to diversify the book. On the JLG book, I think we are growing at 20% CAGR. We've lost market share in that business because we've exited some of the states which we thought, or slowed down some of the states where we thought over leveraging was happening. I think our flows are anywhere between 2.5% to 3%, which is 50 net flows between 55 basis. But that's where our credit cost will always be in the MFI. I don't think an MFI business can run at 100 to 120 basis points. I've been saying it. It's not advisable to accept to have that guidance. I think we will always be at 2.5% to 3% credit cost on the MFI business, and this quarter we were at 55 basis points net flow.
Okay, yeah, that's true. I mean, that's a fair point about MFI as a business. Your retail book, both in terms of deposits and in terms of loans, has done very well. Can you give us a little more guidance in terms of how it's doing? You just told me that vehicle book, despite the problems, is showing a sign of recovery. Can you give us more nuances about how the retail book did and will do?
So I think our CFD, which is vehicle finance book, is very well diversified. We have an 87,000 crore book, which we've reported. It's about 26% of our book. It comes at a yield about 12.6% and a credit cost of about 1.3%. 3%. It will go down to 1% as we go along. This year we will end at 1.18% credit cost on that book. I believe that the book diversification has really helped us. Our book is now diversified into 6 vehicle categories. MHCV, which was the large portion of our book, is now only 20% of our book. The LCV part has now become a very large book. We have car, we've got a 4% market share in new cars as well as used cars. We've tractors, we've got two-wheeler loans, and we've got construction equipment. Okay. So I think this book is now very well diversified, no concentration risk on the book. I think we saw some flows coming in the MHCV segment, but we believe that will get stabilized. The growth in the MHCV segment did suffer last quarter, but in spite of the growth being lower, I think we were able to show a very large disbursement and a 20% growth on this book.
Okay. Fee income has been weak.
The other part
is there anything... Sorry, I mean, can you get to fee income? Anything that you're doing to strengthen that? Because that was a weak one.
So, no, I think our fee income was between 1.8 to 2%, and that's what we've said, that it will always be between 1.8 to 2%, and 69 to 70% of our fee income comes from consumer bank. So I think the corporate bank fee is going to be subdued, and I don't think we have investment banking fee anymore. So that's where the issue is, and I think our fees will continue to fluctuate between 1.8 to 2% of the assets.
Okay. Will you be looking to raise capital? The market is in a kind mood.
As we've said before, we are well capitalized as of now.
Yes.
We will, I said that 3 quarters ago also, that we will evaluate quarters after 6 to 8 quarters. And I think the 3rd quarter of this year is when we will evaluate whether we need capital or not. As of today, I think we're well capitalized and our internal accrual should be enough to meet the growth. Even if you look at our RWAs, if you take out the unsecured 30 basis points which we've added for the risk-weighted assets, our risk-weighted assets on the corporate book has shown a decline, and we would have accreted capital on that book rather than reduced capital. So I think we've used our capital judicially, and we will continue to use it judicially.
Okay, I'm out of time, but a very quick question. Did RBI speak about the CD ratio, and what is the goal you're working to for the current quarter? They've spoken to everyone.
So we are at 86 to 90%, and that's what our range has been for a long time, and we will continue to be at 86 to 90%. RBI has not talked to us about the CD ratio. I think we've always been well within our means on the CD ratio.
Okay. Fair enough. Yeah, 86 is, or 80 is not something that one should worry about. Thank you very much, Suman Katfalia, and congratulations once again. When your results came up, it did help the banking sector. But today, of course, things are all a bit under the weather. Thank you very much for joining us. Well, that's it on this edition of Bazaar. Thank you very much for watching. Chartbusters in a minute.